Good morning, everyone, and welcome to the 5th edition of the We Are In conference. I'm Caterina Mendicino, advisor in monetary policy, and one of the founders of this event, which the ECB jointly organized with the CEPR and the BIS. At the ECB, we are particularly delighted to host this year's conference for the first time here in Frankfurt, which makes this anniversary edition even more special for us. And it is such a pleasure for me to see so many of you here today and to know that some more are connected online, waiting for the start of the conference. But before we start, let me just a quick note on logistics. So we are a bit tight on time, so I would like to ask you to keep discussing about the papers and the topics of the sessions, also during the breaks. And now, in the interest of time, let me stop here and invite Ms. Nabel on the stage to welcome all of us. I'm sure she doesn't need any introduction. She's our member of the executive board here at the ECB, and we are looking forward to hear her words. Thank you very much. Isabel.
Good morning, everybody. It's my great pleasure to open the 5th edition of the We Are in Macroeconomics and Finance conference, jointly organized by the ECB, the BIS, and the CEPR. Let me warmly welcome all of you, and especially all women economists, early career researchers, senior scholars, and students who have joined us today in Frankfurt. We have 2 very interesting days ahead of us, discussing cutting-edge research by both established and emerging female economists. Allow me to briefly reflect on the purpose, history, and aspirations of this conference. The We Are In initiative, that is, Women in Economics, Advancing Research in Economics Internationally, was launched to amplify the voices, contributions, and networks of women in macroeconomics and finance, particularly at the intersection of academic research and policy. This conference is a central platform for that mission. It fosters exchange among female scholars, strengthens professional networks, and addresses the persistent underrepresentation of women in economics and the gender gap in career outcomes. Providing support to young women through mentoring, networking, and visibility has proven essential in helping close those gaps. And this is precisely why gatherings such as today's conference matter. The very first edition of this conference, opened by President Lagarde, took place remotely during the COVID-19 pandemic. At the time of physical isolation, it created a vital space for staying connected, a reminder that strong professional networks are not a luxury, but a necessity. Since then, the We Are In conference has grown into one of the ECB's flagship events. Each year, it brings together researchers whose work engages with the key issues faced by central banks and policy institutions. This is also a broader recognition that diversity strengthens the quality and relevance of economic debate. Attempts to discredit diversity and downplay its importance do not refute scientific findings that diverse teams produce better outcomes. This conference embodies that principle. Marking its 5th anniversary, this edition is evidence of the expanding presence of outstanding women in macroeconomics and finance, an area where women have always been and still are underrepresented. The fact that the ECB, the BIS, and the CEPR co-host this conference underlines our shared commitment to building bridges between academia and policy and to making our profession both more inclusive and more impactful. Supporting the next generation of young researchers is central to this mission. Current pressures on the academic job market make this support even more important. The PhD poster session offers emerging scholars an opportunity to showcase their work, engage directly with senior researchers, and gain visibility within our community. And this really matters. Turning to the conference program, we are happy to have such a great collection of papers which provide the analytical foundation for understanding how our economies function and how policymakers can respond to current developments. The papers presented this year comprise a wide range of pressing issues, from financial intermediation, climate finance, innovation, productivity, and geopolitics, to monetary fiscal interactions and the role of heterogeneity. At their core, all papers address a fundamental question: how can our economies deliver strong, inclusive, and sustainable growth while safeguarding stability in an increasingly uncertain world? The research presented here points towards 4 strategic priorities. First, we must reimagine our financial systems amid digital and climate-driven change to understand evolving risks and seize new opportunities. Financial infrastructures and markets are undergoing profound transformations due to technological advancements. Digitalization is changing financial transactions at their core, introducing new infrastructures, payment systems, and institutions. Understanding these changes is crucial to identify both opportunities and risks for growth and stability. At the same time, climate change remains one of the key challenges of our time. Many initiatives are underway to create incentives for the financial system to support the transition towards greener and more sustainable finance. These should not be reversed due to changes in political moods. Second, we need to unlock productivity through people, not just technology. The productivity challenge facing advanced economies is often portrayed merely as a technology gap, favoring early movers. Yet, research shows it is equally a diffusion gap. Talented managers are systematically misallocated. This points to 2 priorities: improving how we train and match managerial talent within firms, and ensuring that markets remain competitive so that each technological wave creates opportunities for new champions rather than entrenching incumbents. Third, we must prepare for a more fragmented global economy. Geopolitical tensions are reshaping our economies. As trade routes shift, we see not only new patterns of commerce, but also changes in pricing power, currency denomination, and credit conditions. When cross-border lending retreats, exposures may migrate into affiliate structures that escape oversight. Fragmentation may bring new inflationary pressures, alter credit conditions, and generate risks that current frameworks may not fully capture. Policymakers must therefore rethink the design of sanctions, cross-border payments, and prudential buffers to reflect the new reality in which firms and banks operate. Fourth, we need to constantly rethink our monetary toolkit. Recent research has challenged conventional wisdom. Household differences may matter less for aggregate demand than we thought, shifting attention to sectoral propagation through supply chains. Fiscal monetary interactions can be more powerful than traditional models suggest. And monetary policy itself appears to work faster and more forcefully than previous estimates implied once shocks are properly identified. These insights require that we invest in granular data, sector-specific analysis, and frameworks that capture the full range of transmission channels to make our policy more effective. Across all these themes, one message stands out. The challenges of growth, stability, and transition cannot be solved by institutions alone. They require diverse voices, your voices, rigorous evidence, and collaboration across boundaries. That is why this gathering matters so much. The focus on women in macroeconomics and finance is not only about representation. It is about unlocking talent, creativity, and insights that make our policies and our economies stronger. The challenges are significant, but the expertise and energy represented in this room give me great confidence. Let us use these 2 days not only to deepen our understanding, but also to inspire each other to build an economy that is more resilient, innovative, and inclusive. I invite all of you to engage actively. Don't be afraid to ask questions, challenge assumptions, exchange ideas across sessions, and build connections that will outlast the event itself. I wish us all a fantastic conference, and I'm sure that you're going to enjoy the 5th edition of We Are In. Thank you very much.
Thanks a lot, Isabel, for your remarks and your words of encouragement to kick off this conference today. Our conference was great having you here, and see you later in the afternoon. Good morning and welcome to everybody to the first session of the We Are In conference, session on financial intermediation in banking. We have 3 fantastic papers lined up for presentation today. Our first speaker is Manju Puri, professor at Duke University. And their paper on digitalization and credit access will be discussed by Paulina Medina from the University of Houston. So Manju, you have 25 minutes, and the floor is yours.
Thank you very much. It's a pleasure to be here. And so let me get straight to it. So the title of this paper is Breaking Barriers to Financial Access, Cross-Platform Digital Payments and Credit Markets. It's joint work with Shashwat Alok, Pulak Ghosh, and Nirupama Kulkarni. And so let's get to what is the motivation of the paper. It's pretty straightforward. 1.4 billion people around the world don't have bank accounts. And even if you have a bank account, it doesn't mean that you have access to formal credit markets. Now, this is not just an emerging market issue. The FDIC, where I was on deputation for 2 years, does a biannual survey of the unbanked and underbanked, and even in a country like the US, depending on the time horizon, the unbanked estimate is in the order of 5%, and underbanked is in the order of 16%. So this is a global phenomenon. And part of this, we know fintech has been rising, and so part of the promise of fintech is that maybe they can get people who never had access to credit access through alternate credit scoring mechanisms. And so I have an earlier paper on digital footprints that suggests even a shallow digital footprint, how you access the internet, what time, do you have an iPhone, etc. Information all of us leave behind when we access the web, does as well as predicting default as credit bureau scores. And so this gives us hope. Maybe there's a way for people who have thin credit files to now get access to credit. However, there's little evidence so far, at least in the US, that fintechs have delivered on this promise. And so part of the problem is, there's a cold start problem. How do you facilitate the creation of digital footprints in the first place? And our focus in this paper is going to be, what if we publicly provide a digital infrastructure where you and I can make payments to each other seamlessly, instantaneously, in a verifiable way? Will that improve access to credit? And for this purpose, we're going to study India's UPI. Now, what is UPI? So essentially in India, the government decided that they would build the public digital rails. So it's a public digital infrastructure funded by the government. Once you have these rails, now anyone can put an app on it. It can be Google, it can be Venmo, it can be PayPal, and it is interoperable. What does that mean? It doesn't matter if you have Venmo and I have Google Pay or PayPal, we can still transact to each other. This is not true in the US, right? I consistently have a problem. How do I use it? Do you have Venmo? No. Do you have PayPal? No. Okay. I'll give you cash or I'll write a check. Here, it doesn't matter who you have a bank account with, what app you're working with, you can seamlessly and instantaneously transfer money. And the net result of this is you have a real-time, zero-cost creation of a digital financial history. Now, why is this important? Can you please click on flowchart? So let me give you an example. Let's suppose, the informal sector is large in many developing economies. So think of a bricklayer, right? Or think of a roadside vendor, right? Selling masala tea, right? Now, so Sharda Masala Chai Wali, she sells masala tea. All she has is a broken down cart. No bank is going to give her a loan. There's no collateral. There's unverifiable cash flow. So what do? Now, however, enter UPI. And now what has changed is, so I go and I say, hey, I'd like a cup of tea. The cup of tea is $1, okay? So now she says, sure. So I have the QR code. So I put in Sharda Masala Chai Wali, ICICI Bank, whatever the account is. And so then what's going to happen is, so I enter $1 into this. So it goes to the UPI rail, which goes and checks, okay, in this bank. Does she have an account, etc. Sends the account detail. Then it goes to my bank, let's say Bank of America, checks my account, debits $1, goes ahead, credits Sharda Masala Wali's chai, and then confirms. All this has happened in 2 seconds. So before I can even take a sip from my cup of tea, we're verified. This transaction has happened. It's digitally verified. Can we go back to main, please? And so now what's happened is you've moved from having basically just a lot of cash, right, to a digitally verifiable cash trail based on which you lend. And so, yeah, sure, you may just have a cart and you may be selling masala chai, but you're a hard worker, you work 8 to 8 every day, 7 days a week, you make the world's best chai, and you sell a lot of it and at a good price. So you're making, let's say, $1,000 or $2,000 a month. Now this is verifiable. The bank can look at it and say, I can make you a loan of $200. This is cash flow-based lending, right? And so this, right, is known as open payments, where you have interoperability, right, across your payment system and my payment system, which is really fundamentally the key. You're not locked in any app, and you can transfer to anyone and create this digital verifiable history. And so historically, India, like many developing countries, has been a high cash usage country. However, with UPI coming in, that has changed. There's enormous amount of transactions done digitally. Now, to do this, you need a bank account. The other feature we'll see in India is, the banking of the unbanked, which we know is a big issue. Why do people not have bank accounts? So the FDIC survey of the unbanked will say, look, there are 2 main reasons. One, transaction costs. I open a bank account with $100. I don't do anything. After 2 years, there's nothing left, right? Gets debited in fees. Second, you need a lot of documentation. So in India, the Prime Minister's scheme said, look, hey, banks, you need to open accounts for everyone. So 1, these are going to be zero-fee accounts. 2, if they don't have the documentation, you open it, and then, hey, banks, you are responsible. Make sure within 6 months the documentation is regularized. As a result, 99% of India is now banked. The bank or a fintech can say, fine, I will make a loan of $200, $300 because I can see cash flow-based, revenues of $1,000 to $2,000. Okay, and so this is the question we're asking. India has this very unique digital platform, right? India is now, the 4th largest economy in the world. And I've been working now in fintech for about 10 years. So whenever I go for these conferences where you have both academicians and policymakers, there are always 2 players who are there. One is Google, and the second is India's UPI. Everyone wants to know what's happening here. Bill Gates goes to India to check it out. Why? This is a massive, massive experiment. And if it works, it's a template that others can follow. So we ask, when you have these digital rails, do you improve access to credit? If so, to who? On the intensive and extensive margin, And importantly, what about people who never have access to credit before? Do they start accessing credit? And if so, where is this credit coming from? Is it banks? Is it fintechs? Is it both? To which subsector? And how does the distribution sort of change? So let me give you a quick preview of the results since my time is short. So the short answer is increase in credit across the board, right? To everyone, prime, subprime, new to credit. Everyone is giving more credit, both the fintech and the banks. A rising tide sort of lifts all ships, everyone is getting it. However, who is giving credit? Banks and fintechs respond differentially. Banks are more likely to give us, well, all this extra credit, are we just going to have? You don't actually have higher defaults. Now, why should an open digital payment infrastructure affect credit? Well, theoretically, it can go either way. On the one hand, banks are a traditional supplier of credits. This is breaking their monopoly power, and so maybe their investment will go down, lower supply of credit. On the other hand, competitions, you have fintechs who are young, hungry, and nimble, and so maybe you're going to see an expansion in credit. And so what happens is an empirical question, and that is what we're going to look at. So we say this is the first large sample study. Really, this is using the whole of India. We have the universe of data from Credit Bureau, not 5%, 10% from TransUnion, as we have in the US. We have 100% from TransUnion. Not professors, not high-tech guys. Average Indian consumes 24 gig of data a month. When they see my internet plans, they laugh, right? Because it's so expensive, right? And data there is like 7 cents or something, right? It's incredibly, incredibly cheap, right? Okay, so this is how UPI transactions have grown. So you can see it's a hockey stick, right? And we have to collect a ton of data to figure this out. So we are going to get lots and lots of data. Our main source is going to be the credit registry. Importantly, from the point of view of financial inclusion, we know who has never got access to credit. We can control, are you prime, subprime, et cetera. We know who is the lender. Is it fintech or is it a bank? And we know the amounts, number of accounts. I'm not going to go through all the data, but there's a ton of other data you need to mix and match. We're going to need UPI data. We're going to need branch deposit data. We're going to need to know about these JDY or previously unbanked people. To do our experiment on telecom rollout, we're going to need data on the 4Gs, et cetera. And so we have all of this, and we combine it together. If you remember nothing else, remember this graph. I already showed you UPI transactions up like a hockey stick. And as UPI transactions are going up, look at what's happening to credit, right? For every 1% increase in UPI payment, there's a 0.7% increase in loan amounts. This is so strong. It's so massive. I'm going to do 3,000. How do we identify this and estimate it? Now, in order to use UPI, you need a bank account. Right? And so when UPI is introduced, banks have to sign on. Some banks sign on early, some banks sign on late. So we're going to take advantage of this early versus late sign up, right? And so this is sort of used in Dubai and Puranandan. We're going to take that and expand on it, right? And the idea here is, so let's suppose we're here at the ECB, and all the banks around here signed up for it. Then the exposure is going to be 100%. If no one signs up, it's going to be 0. If half of them sign up, it's going to be 50%. So we're going to use that as a continuous measure at a very granular level, at the PIN code or the zip code level. And we're going to do it by deposit share, right? Now, you might ask, well, maybe, some banks, certain kinds of banks sign on early. But remember, if you sign on, you can't choose to sign on in some areas or not. If you're a national bank, you're signed on everywhere. And so we do a balance test, again, right at the PIN code level for all kinds of differences in economic and other activity, and we don't find any difference, right? And so we're doing this at a very granular level, which is the PIN code or the zip code level. And we're going to control for time-varying local factors using district month fixed effects. We're going to go even further, right? And so we go even more granular. There are two ways to do it. That is, you can divide the map into grids. So let's suppose I take the ECP, this area, and now this becomes a grid. And within that, there's one area where the banks all signed on for UPI and the other where they didn't. I'm going to look at the difference. The argument is going to be we're across the road. Any other economic shock should be common. The only difference is, banks here signed up for UPI and there they didn't. Right? So we're going to look at these very narrow geographic areas and see, and our results are going to go through. Alternately, you can take the boundaries of pin codes, zip codes, and look on either side where there's high and low. It'll reduce the sample size, but the thought experiment is similar. Very, again, similar results. Okay, so the first thing is we're just going to look at UPI transactions on the left-hand side and look at our UPI exposure measure on the right-hand side as a reality check. And it's exactly the way you want, right? And that is if the exposure is higher, right, more banks have signed on, you're going to have a ton more UPI transactions. We're now going to look at credit access. So the left-hand side is going to be the total number of loans, or we also do loans per capita. On the right-hand side, we're going to have our exposure measure, all these district month year, PIN code, fixed effects. We're going to cluster at the PIN code level. We're going to look at differences between fintechs and banks. And so here, are the coefficients, for fintechs. So you can see it's sort of flat before the introduction, and after that, it's like a hockey stick. Same thing for banks, right? This massive growth after UPI is introduced. So it is clear UPI is a game changer. The question is for who? So we now are going to run all those regressions. So each coefficient here is coming from a regression, right? So I'm going to divide into prime, subprime, and new to credit. I'm going to run this separately for fintech, separately for banks. And you can see here, all the numbers, except one, are sort of positive and pretty big, right? What this is saying is that if you look at fintech, 26 times the number of loans per capita, right? And banks, it's 16%. Now, take it with a pinch of salt, because remember, fintech start at a base of 0, so it's not quite correct to just say the number. But if you look at the absolute amounts, right, as I showed you, new to credit by fintech is now the same as what banks are doing. And new to credit banks, 0 increase. That's not where banks are going. They're lending more to prime borrowers. So again, now, let's look at the regressions. And this is just putting it, the whole thing there so you can see. And so you can see here all the numbers, new to prime, subprime, prime, positive and significant. Everyone is getting more credit, but from where? So fintech, again, everything is significant. When you do banks, the new to credit is insignificant, right? It's far more significant. Prime is the biggest one, right? Lots and lots of robustness checks, as any good paper has to do these days, right? We do the grid time, fixed effects, which I explained. We do the neighborhood pairs, which I explained. We've used so far the continuous UPI measure. We do a binary one, which we explained. Then India at this time underwent demonetization. Could that have an effect? Now, our tests actually capture that, right? Remember our little grids? So if there's demon, right, whether you're across the road, I'm here, we should be affected the same, right? So the only difference is the high and low UPI exposure. Nonetheless, we do an additional test. We control for variation in cash availability. So it's from the nearest currency chest that other people have used to proxy for the demon effects. We find very similar effects. Then let's look at complementarities. So what have we found so far? UPI increases lending. Now, but to do these digital trails, you need to have good internet, not just good internet, cheap internet. And so Jio, launched by Reliance, they sort of said, we're giving dirt cheap internet, and they launched lots and lots of 4G towers. We're also going to look at the previously unbanked or the JDY accounts. So let's look at geo. So this is the way geo rolls out towers. So you can see massive increase in the 4G towers. And this is what happens to the coverage in India. Spotty in 2016, covered densely by 2020. The average distance to a tower goes down from 15 kilometers to 2 kilometers. Normally, if you're within 4 or 5 kilometers of a tower, you have very good coverage, right? And look at the cost of data, less than 10 cents a gig, right? And so now we look at what is the effect of credit, and you can say, you can see the complementarities both for fintech and for banks. So you can see with fintechs, when geo comes in early in an area, right, you see much more credit across the board. The same thing with banks, again, insignificant for new to credit, but significant everywhere else. We again do robustness. We look at, well, what if you have internet, but it's expensive? This is non-geo operators, and compare. And it really is good but cheap internet that is driving this. We also then look at formalization through having bank accounts. Our JDY are the previously unbanked people. So again, we look at what is the effect of access of credit. And you can see where you have a lot of JDY accounts. So this is where a large amount of previously unbanked population, you actually see a higher effect of UPI coming in, right? And this is particularly, again, significant for fintech, not for banks, right? And so the risky, new to credit borrowers, fintech leading the charge. Now, how much are we talking about? So far I've been telling you number of loans. Let's aggregate this into the aggregate amount of credit. This is what we have. Let me put the interpretation. 1.99 million increase in low value and high exposure PIN codes. So that's economically about a 22% increase relative to the pre-treatment mean. So that's a difference. There is a big difference in the ticket size between banks and fintechs. Fintechs do these small ticket items. The average size is about $200. Banks, it's 9 or 10 times of this. This makes sense. Banks are risky. Banks are regulated. They have the examiners on their back. They don't want to do these small ticket risky loans. Fintechs are happy to do it. They're the new entrants. They're nimble. Their transaction costs are low. They come in and sort of eat up this segment. You might ask, what is the impact on default? And clearly, riskier loans are going to default more. So that's not the right way to look at it. What we should look at is controlling for risk. What is the difference in default between making loans by the old technology and the new technology? And you can see when we do that, it really is nil. And when you do it in the multivariate, it's either zero. If anything, you're marginally decreasing defaults. You certainly are not increasing defaults. OK. And so that's separately for fintechs, separately for banks. Let me conclude, right? 850 million people in India either do not have access to credit or not to enough credit, thanks to thin or non-existent files. This is a global phenomenon. And so first order question is, how do we expand access to formal credit to the marginal population? Can a cross-platform, seamless sort of digital infrastructure help? And using the full universe of the TransUnion or the credit bureau data in India, we find the answer is yes. Everyone gets more credit, but particularly the underserved, particularly people who never have access to credit. It is fintechs leading the charge. And not only this, people who previously never had access to bank accounts, it's again fintechs expanding credit there. We find these effects are stronger when you have cheap and good internet connectivity. And importantly, this increase in credit is not resulting in higher default rates when you control for the credit rating, right? So if anything, the new technology, is marginally getting you better, better results, certainly not getting you worse. And I think I'm right on time. And so thank you.
You have 10 minutes.
Yes, thank you. All right, well, good morning, everyone. Thanks to the organizers for inviting me to discuss this paper that I very much enjoyed reading. And while we wait for my slides to come up, yeah, I can tell you that at a high level, this paper is asking the question of whether the diffusion of payment technology can equalize access to credit, or if instead it's going to deepen existing inequalities in access to credit. And the authors do that in a way that combines micro evidence on lending to speak to a macro question of financial inclusion and payment system infrastructure. And to see that, let me start by telling you a little bit how traditional lending technology works, and simply by emphasizing that traditional lending technology relies heavily on credit histories for credit origination and pricing decisions. Nevertheless, a large fraction of the population around the world simply lack credit history. When a lender faces individuals without credit history, they don't have a technology, they cannot use their technology to distinguish good payers from bad payers, and often they end up rejecting these applications of approving them with unfavorable terms relative to their true credit profile. And in theory, alternative data could eliminate the cycle of exclusion that arises from having no history, no credit, and no history. In principle, alternative data could break this cycle, and that has been at the center of an active literature pioneered by Manju, and in which I also have the opportunity to work on, that shows that alternative data can be a complementary or even an alternative input for credit scoring technology and can lead to credit scores that are as precise as those calculated with traditional data. However, credit scoring, which is at the center of that literature, is not the same as credit access because there are many reasons why banks may not use this technology to expand access. On the one hand, it may be more profitable for banks to offer more credit or better credit to individuals that already have access. At the same time, it could be that maybe these credit invisibles could organically get access to credit over time, just making this technology less impactful or to expand access to credit, or maybe the barriers to adoptions are so high that banks would not use it. That's why this is inherently an empirical question that Manju's papers try to address, and they do that by taking estimating the treatment effect of UPI adoption on access to credit. For identification, they exploit that some banks adopted UPI earlier than others, and they basically compare the number of loans in PIN codes that have where these early adopting banks have low market share to the number of loans in PIN codes where these early adopting banks have high market share in the deposit market before and after 2016. And what they find is that indeed, this is a story about expanding access and not only giving more and better credit to those that already had access. And they find effects that are in the order of magnitude, if we look specifically to new credit to by fintech companies, between 5% of the mean or even 16% of the median, because it's this very skewed distribution. So overall, I think there are many things to like about this paper. It's clearly a first-order question that has a lot of economics into it. So my comments are going to be focused on two things. First, potential mechanisms behind these treatment effects, and second, the dynamics of how access to credit evolves when this technology is introduced. My first comment is about what UPI brings in to the table. And the first thing that comes to mind is what can be called a sort of verifiability effect that arises because some transactions that were going to happen in cash are now going to happen with a digital payment method that leaves a trail and that can benefit merchants and customers in different ways. On the one hand, for merchants, now we have clearly verifiable income, which is what Manju was referring, and which is cash flow-based lending. Alternatively, consumers may also be leaving a trail of their spending patterns that can be an input into these sophisticated machine learning methods for credit scoring technology. But as I was reading the paper, another mechanism that came to mind is something that I was reminded from the typical premise on payment, the economics of payment systems, which is that accepting digital payment methods is actually a competitive tool for merchants to increase volume. That is to say, in this context, I'm a merchant, I'm a street vendor that's selling masala tea chai on the streets, and as a consumer, I may go to the vendor that accepts UPI instead of going to the vendor that doesn't accept UPI because it's more convenient for me to make that transaction. This is an important distinction because, in a way, these two channels have different policy implications. If the story is indeed about the verifiability of transactions, then the emphasis going forward needs to be focused on data sharing standards and how do we make this type of information available to more lenders. If the story is more about volume effect, we're in a situation in which increasing the revenue that merchants have is equivalent to increasing the income in this population that can in itself have impact to access to credit through different mechanisms. But the good thing is that I think the authors have very rich data that can allow us to understand at least how important these alternative mechanisms are. On the volume effect, I want to emphasize that I'm not talking about a confound that is biasing the estimates, because as Manju mentioned, they have very rich data, very rich specification that is very convincing that this is not a story of an unobserved shock, but we're talking about this being a treatment effect to UPI adoption. And the authors can simply change the outcome variable and see if UPI adoption is also increasing the income of these street vendors that now can clear more transactions because of the convenience and the competitive edge of accepting UPI. And on the verifiability side, I think it will also be important to better understand if this is a story of cash flow-based lending or if this is a story about sophisticated machine learning by which consumers leave a lot of information about their spending patterns. And one quick way that someone could get at this is by seeing if the story is different in areas when there are a lot of incoming transactions that will be more indicative of cash flow-based lending, or more outgoing transactions that will be more indicative of consumers revealing their spending patterns with their transactions. And a final point to that end, related to opening up the number of UPI transactions in a PIN code, is that it would be interesting to know how many transactions do you need to be scored. And in some of the work that I have the opportunity to work, we know that you don't need a lot of transactions to be scored with a lot of accuracy. And in that sense, I wonder if the number of UPI users in a PIN code would also be informative to see if it's just about using UPI, it's not about how intensely you use UPI, that can inform the type of data sharing that we want lenders to have access to. Do you need the entire transaction history, or is it enough to just give you access to your cell phone and the more shallow digital footprint that comes when you download any of these UPI apps? And my second comment is about the dynamics of treatment effects. This graph that Manju shows us, we can see that treatment effects grow over time. I find it very interesting that given that the identification is so rich and ultimately is comparing even neighboring PIN codes with high and low baseline levels of early adopting banks, I would have expected that the spillover effects would spill to the neighboring PIN code. And if that were the case, maybe we would expect a flatter dynamic. Yet again, the data the authors have is so rich that allows very clearly to test whether that is the case or not, because I would be very curious to see if UPA use follows that same dynamic as the treatment effects in neighboring PIN codes. It could very well be the case that in 2 years of history, the early start of early adopting banks survives, and this is the dynamic of UPI transactions. I think that would really help to justify these increasing dynamics in access to credit. Overall, I think it's a great paper that speaks to this first order question of whether this new scoring technology is indeed expanding access or alternatively widening credit disparities. I'll be curious to learn more about these mechanisms that I mentioned and about the dynamics of UPI use. Thank you very much.
Samantha, would you like to take a couple of minutes and then we respond, and then we open the floor for questions?
Thank you very much for that discussion. So I'll just very briefly respond. I think you raised some good points. Like, the first is, what is the mechanism? And in our mind, I think it's quite clear that the mechanism is different across different segments. So when I'm looking at prime, they already have access to credit, and yet they're taking on more credit. Why so? So I'm thinking it's people like you and I. You go to buy, let's say, a refrigerator. Normally, you wouldn't take a loan, a couple of $1,000s, but now the transaction costs are about $0 to do it. You can push a button on your mobile, and 5 fintechs and 6 banks will tell you, we'll give you a loan at this maturity, at this interest rate, very easy. And this is also why these are now small ticket items that we're seeing. But the dynamics are very different for people who never have had access to credit. And so there, it's how do I even have once I have the digital trail, you're right, then the distinction is, is it volume, is it machine learning? I didn't even have a digital trail before, right? So we moved from 0 to having a digital trail, which is enabling it, right? And so first you can see the cash flow. Maybe if you're a fintech, as my paper and your paper has shown, you can do more of this alternate credit scoring mechanism. But importantly, you need the digital trail. That's first order, and that's what we are establishing. Now, in answer to your question, we do have a test, which is actually in the appendix, where we get data from a single very large fintech to see how are they doing it, right, for these roadside stalls. And what you see is, the more the UPI QR codes, the higher the internal credit score, the bigger the loan, the reduction in interest rates, right? Very consistent with sort of this cash flow based lending. But, to be clear, in our paper, we're saying creating the digital trail is first order important. Once you do that, you automatically see access to credit. Now, on the dynamics, you have to be very careful, right? Why? Eventually, at some point, everyone has adopted UPI, right? And so really what we are doing is we're exploiting the early differences. If you go long enough, and like today, everyone has it, so you're going to see effects everywhere. And so we're exploiting the early differences, and you have to use your bank account. So even if you're just across there, I don't have a bank account, I can't use it, right? Unless eventually I shift my bank account, right? Or eventually my bank signs on, et cetera. And so at some point, it is going to equalize, but that's sort of what we're taking advantage of.
Thanks a lot. Let's open the floor for questions. So I see one over there.
Thank you, Philip.
Oh, please stand up and say your name and affiliation. That's
okay, thank you, Philip Hartmann from the ECB Research Department. So a very interesting paper, very impressive, both the experiment in India and the research about it. 2 quick questions. So for my understanding, like what happened after 2019, like this is an experiment. So, but like from your knowledge, what happened after 2019? Because I saw this data stopping 2019-20 something around. So what happened around there is like, did it plateau? The hockey stick became the back of the elephant, or something else? And the other is that sorry, I lost my. Sorry, excuse me. I stick it.
We'll take a few questions, then I'll answer.
Yeah. Front row.
Thank you so much. Juanita Gonzalez-Uribe from London School of Economics. Great paper, Manju. 2 questions. One, do you know anything about prices? I'm interested in whether the model, the business model of banks and fintech also kind of changed around that time. Are you just given more out loans but a lower price? And finally, how does that affect the competition between banks and fintechs?
Hi, Christina Molnar from Norwegian School of Economics. I'd like to broaden the perspective a little bit, ask about a bit of macro implications, following on the discussion of Paulina. So from the household's perspective, do you see any evidence of their consumption demand increasing? Because it's not only switching from cash to digital, but being less credit constrained because of this new financial innovation. And then, of course, that can have macro implications for with increased demand and so on and so forth.
There's a question over there.
Hi, Refet Gürkaynak, Bilkent University, and this month ECB. Wonderful work, thank you so much for this. This treats the entire being unbanked and cash dependent as being external to these people. So once they had the opportunity, they changed. But you also used the word informality in your presentation. And I would have assumed some of these people actually chose to be outside the system. So once you create this digital payments trail and a revenue trail, of course, it makes you more eligible for borrowing, but it makes you very much eligible for being taxed as well. And I would like to know, A, do we see a taxation impact of this? And B, is there a selection? Is it a group of people who actually chose to enroll in this and some other people actually chose to be informal?
Is it okay if we take one more question? Because I saw some more hands on this side. Yeah, there.
Thank you. Irina Steven from the University of Hamburg. I have a question following on Christina. She talked about consumption implication, but also what is about income implications. And overall, you should see huge boost of the economies, right, in this couple of years. Do we see something at the macroeconomic level? Thank you.
Yes, Hélène, yes.
Take the opportunity because the mic is right here.
Yes.
No, so I had a question on econometrics. Did you try the Duchesne-Martin Aufeuille estimator? I don't know if you know about the staggered adoption, because as you mentioned, there is this dynamic effect of in the treatment. And then because there's a lot of discussion on stable coins, and it goes a little bit in the direction of Refet's question. So it seems like the UPI has, a major positive advantage compared to stablecoin, which is precisely this trail in order to get credit. So how do you see? So therefore, do you see that in India, stablecoin have any future or not because of that, or do you think that this kind of avoidance, not wanting to be recorded kind of motive would be an important motive of adoption?
Okay, so can I?
Yes.
So thank you. Let me answer the questions in the order that was raised, right? So we stop at 2019. Why? COVID is coming in, and you're going to see all kinds of confounding effects. We also want to look at, the early versus late. It's very clean. At some point, you go into 2022, 23, everyone is going to adopt it. So it just seemed that was a natural stopping place so that we can sort of get clean, we can do clean tests and not worry about the confounding effects of COVID. Then Hunita asked about the pricing and the price data. So when we have data from the single fintech lender, which is in the appendix, right, there we can look at interest rates. And there you do see, as the number of transactions and as the size per transaction goes up, right, interest rates go down, internal credit scores go up, loan size increases, all very, very, very consistent with cash flow-based lending, right? You have more cash flows, you're a better credit risk, and therefore, the pricing is better. And while, you're looking at competition, it is becoming increasingly clear that fintechs and banks are catering to different segments, right? Everyone is competing for prime, right? And banks historically have been serving them. Fintech are still getting some of that market, but banks certainly love prime. But the new market, right? These guys who never had access to credit, who didn't have bank accounts, who are risky, fintechs are taking the lead. So you're seeing that now. So fintechs have less competition from banks, but fintechs certainly compete against each other, right? And so, you know, I think that's what you're seeing in the marketplace. Then there were two questions on the macro implications or the real effects, which I think is a very good question. It is not something we study, but it is something that others have studied, in particular, Dubai and Puranandam. They look at, using very different data, they're using survey data, to look at, you know, what is the real effect of UPI, right? And on some of the kind of things that you mentioned, and they are finding, like, in general, a positive and a significant
Sorry, Manju. Unfortunately, I have to stop you because we are really running out of time, and we are very tight with time. But we can continue the discussion over coffee. Sure. Thanks a lot for the excellent presentation. Thanks you all for the discussion. Coffee, there's a coffee break right now, so you can continue the discussion, ask questions to Manju right there. But thanks a lot and for the excellent Welcome to the second part of the first session on financial intermediation banking of the We Are In conference, the 5th edition of the ECB. We have 2 more papers in the session. The first one will be presented by Elena Carletti, professor at Bocconi University, and their paper on climate and climate lending and common ownership will be discussed by Eleonora Sprappini, professor at the University of St. Andrews. Elena, the floor is yours, and you have 25 minutes.
Thank you. Good morning to you all, and thank you very much for the invitation to this conference. This is somehow, for all of us, I guess, an unusual setting in that we are not used to have such a female audience in front of us, so I think this is really unique and very special. And it is so unique and very special that when Agnese asked me to present something in this conference, I thought that this would be a more informal gathering to get advice and suggestions and feedback on work in progress. So what you're going to see today is not something that is so formal and final as the nice paper by Manju, but it's something really work in progress. So it's more the direction of travel that you have to get, more than the individual and the specific result. And I want to apologize with Eleonora because she did not see any paper, and she just received a set of slides and even changed yesterday at midnight. So this is where we are with this. So having said that, let me tell you what is it that we are trying to do. And again, the main objective for us is to get feedback, in particular on how to bring this travel further. So we all know that there is a high exposure of banks to fossil fuel firms. But maybe we don't know that if we take the 65 bigger banks in the world, they have committed to almost $8 trillion of financing to fossil fuel industry since the Paris Agreement. Now, we can say whether this number is big or small, but it sounds a lot still, given that we wanted to go towards a situation where there would not be much financing to fossil fuel industry. And we know that this has implications for financial stability. But apart from this lending exposure, we don't really know whether there are other ties between the fossil fuel industry or the brown industries more generally and the financial sector. So this is precisely what we want to do in this paper. We want to look at whether there is another type of tie, which is common ownership. So to which extent have fossil fuel firms and banks similar or the same shareholders? And to which extent is this an important phenomenon for lending conditions? In particular, we want to look at 2 main questions. First, how does common ownership between banks and fossil fuel firms has evolved over time? And in particular, how it has evolved as a response to climate policies. So take the Paris Agreement, for example. Have we seen that the Paris Agreement has reduced these ties between fossil fuel industry and banks? Or on the other hand, instead, it has had the opposite result of increasing these ties? And we are going to use 2 measures of climate policies. One is the Paris Agreement, and the other one is the level of environmental policy index, which you may know is an index in the United States. It looks at the most important US newspaper, look at 80,000 news, and basically calculate an index that is this measure of stringency of climate risk, of climate policies, so of fight against climate risk, if you want. And then we want to see, okay, once we establish this common ownership between banks and fossil fuel, and we compare this to common ownership between banks and other industries, does this affect the lending? And in particular, does this affect pricing? And we are going to look at syndicated lending. So what are the main results in brief? So as we would expect somehow, and as would be desired, common ownership between banks and fossil fuel is typically lower than common ownership between banks and other firms, as these climate risk policy measures become more stringent. However, we need to distinguish between intensive and extensive margin, in that what we find that for the situation where there was already common ownership between banks and fossil fuel firms, this common ownership does not decrease or even increase after the Paris Agreement or when this index becomes more stringent. And instead, what we find is that on the extensive margin, instead, there is less likelihood. So basically, if in a pair of fossil fuel firm and the bank, there was already a common shareholders, then this relationship may increase after the Paris Agreement and when this index becomes more stringent. Instead, if there wasn't any tie in terms of common shareholding, then this tie is less likely to appear. So there is a big difference between intensive and extensive margin. And how does this affect the prices of syndicated loans? Well, loan prices are lower when there is more common ownership between banks and firms. And loan prices for fossil fuel firms tend to be higher than for other firms. But again, after Paris Agreement, these prices are lower. So again, we get a different result, an opposite result from what we would have liked to see. That is, if there is Paris Agreement, it should be more difficult, that is more costly for fossil fuel firms to get funding, and instead we get the opposite result. So this is where we currently are. As I said, it's very preliminary. We don't claim any causality whatsoever, but we thought that at least already describing this phenomena of common ownership is in itself interesting and important. So let me skip the contribution to the literature for sake of time, and let me tell you instead more about the methodology. So I do refer to common ownership, but what do we really mean for that? So the first one is simply the number of overlapping investors. If you take firms and banks, how many overlapping investors they have, and again, we look at firms and banks, and fossil fuel firms and banks. The second one is the common ownership shares held by overlapping investors, and with a look at the shares in banks and the share in firms. So let me be more specific. So what do you see here? Do we have a pointer? Yeah. So take the first part here. So you have a firm that can be a normal firm or a fossil fuel firm, and then you have a bank, and you have investors. So what do you see in this case? Investor one will have a 5.58% in firm A in terms of shares, and 4.96 in the bank B. So this will be a common shareholder, and this will be, if you do the same with the other investor, this will be the sum of the common ownership in the firm share, so how many shares common shareholders have in the firms. And the same we can do for banks. This investor will have a 49.6, 73.13, 404. If you sum them, this will be the sum of the shares that common shareholders have in banks. And we can do the same before Paris and after Paris, or as I said, depending on the level of this policy index. So you see here, for example, in this particular example, which is taken from actual data, you see that the common ownership shares in firms, which is the sum of these three numbers and these three numbers, before Paris is 16.18, and after Paris, this is 17.15. You can do the same for banks. This is the sum of the common shares in banks before Paris, the sum of common shares in banks after Paris. You see this is increased. And in terms of overlapping investors, in this particular case, it's the same, but we could have a new investor that has come in after Paris. So this would be the intensive margin, if you want, the change in intensive margin. If we had a new investor coming in, this would be more the extensive margin, okay? So this is how we do. And we follow the literature in there, but what we would like to see is a little bit a more synthetic measure that can measure more the strength on both sides. But this is what the literature does so far, and this is what we follow for the moment. Which data do we use? Well, we have the universe of US publicly listed firms from a Refinitiv icon. We have sector disaggregation based on climate policy relevant sectors. And we have, we just take the firms that belong to sector one, which are really the brown firms, the fossil fuel, and then we take the greenest. So the treated group will be the fossil fuel, group one. The controls will be the greenest firms, that is the sector 9, so those that are farthest away from being classified as high climate risk firms. And then we take the 71 largest publicly listed banks, and that are not necessarily in the US, but of course we match them with the US firms, so you should think of these banks as being based in the US, basically, or being active in the US as well. So what is the time frame? We take, for the moment, 2001-2024. We have quarterly information about equity shareholders from Thomson Reuters Global Ownership Database. We use mostly 13F. Then we take all the investors that have at least 1% in either the firm and in the bank. So this is the level of common ownership. We tried with different level of threshold. The literature usually uses 1%, 3%, 5%. We tried also with asymmetric, if you want, shares, meaning maybe 1% in banks, because typically there is more concentration in the bank ownership than in the firm ownership. The results are more or less the same. So in this particular version, we went for 1% on both sides. And then we use syndicated loans data from DealScan, and then we have control variable from Refinitiv icon. So here you can see a little bit the summer statistic, but what is important is that, of course, so these are the common ownership from the firm's perspective in bank and the number of overlapping investors. You can see that here we only look at the Paris Agreement. You can see that there is an increase already in the descriptive statistics, both of the shares in firms and the shares in banks. But basically, and the same for the number of overlapping investors, although in this case you see that the increase is not that much, which again suggests that if there is an increase in common ownership, in particular for the fossil fuel industry, that is more on the intensive margin again, rather than new investors coming in. And if you think, now put yourself in a bank perspective, it's much more difficult for a bank to go up there and say, we start after Paris to finance, we start to have common owners and therefore finance more fossil fuel. It's much easier that if you are already in the business, maybe shareholders try to get more ties, and for the banks it's easier if it is already in the business of lending to fossil fuel. But this is at least what the data tell us so far. Let me move on before Agnese tells me that I'm late. So we start with very simple OS regressions, extremely easy. So what we have, we do an OS estimation in each quarter where we estimate the common ownership, again, from the firm, the bank, and the number of investors. We look at all three measures, and we regress on a dummy of fossil fuel that is equal to 1 when in the pair of bank and firm, the firm is fossil fuel. And then we interact with this, we have the policy measure, and then we interact, and these are the two coefficients we are most interested in. We interact with the measure of the climate risk policy measure. And as I was saying before, we are going to use two different types of measure. One is the Paris Agreement, simply before and after the Paris Agreement. And the other one, we are using this environmental policy index, which is taken from this paper of Noelle et al. And this is an index based on news of US environmental and climate policy on the most important US newspaper, and it's about 80,000, as I was saying, news that they are scrutinized, and then with algorithm, they try to use this news to measure the stringency of policy. And then we have a bunch of a firm and a bank control and a number of fixed effects. So what do we find? So we find, just focus on this, we find that in general, the common ownership between banks and fossil fuel firms is lower than the common ownership between banks and other industries. That is across all specifications of our measures of common ownership. So in general, there are fewer ties in terms of common shareholdings between banks and fossil fuel firms. But you see that this is after Paris only, and after Paris, we see that this becomes even lower. So this is what I was telling you before. This is what we would have expected, that if there is more stringency in terms of climate policy, we would expect that this tie, assuming that this tie has an impact then on lending, becomes less important, that is weakened. And this is what it tells you. And the same goes from this environmental policy index. The result is, again, that the fossil fuel is negative, so there is lower common ownership between banks and fossil fuel firms rather than other. And this becomes even smaller when there is a stringency, when the level of this index indicates that there is more stringent policies against climate in the country. However, we want to disentangle, as I was saying, intensive and extensive margin. So what does it mean? Well, it's normal. When you have extensive margins, so you had take two pairs, there was no common ownership of any type before, and now it starts to be a tie, so the new investor comes in and starts acquiring shares in this pair. And instead, on the intensive margin, is clearly the change relative to before and after. And if we do that, what do we find? This is for the intensive margin. What we find is that still you have a growth rate of common ownership in general that is lower for fossil fuel firms and banks, and this is true across all measures that we can look of common ownership. But this time, after the Paris Agreement, you see that there is a reverse. So after the Paris Agreement, the growth rate of common ownership becomes more similar between fossil banks and fossil fuel than that to other pairs of banks and firms. So in other words, the Paris Agreement that should have led to a weakening of the common shareholdings is actually leading to the opposite result for what concerns intensive margin. We can do the same, and the same holds for the environmental policy index. We can do the same, and more or less the results are the same. If you have more stringent policy index, meaning that the policymaker try to fight somehow climate risk even more, you see that the negative coefficient of the fossil fuel here becomes weaker, so that there is instead a reverse of the initial result. Now, on the extensive margin, however, you see that that's not the case. This is what I was telling you before. So on the extensive margin, we can do the same things, and you can see that the common ownership between banks and fossil fuel is less likely to materialize than common ownership between banks and other firms, and is even more so after the Paris Agreement. So overall, we have lower common ownership between banks and fossil fuel than between banks and other firms. But that is even more true after Paris, but this result is driven by extensive margin, because on the intensive margin, we see rather an opposite result. Okay, so, but now, what do we do with that? So now, can we say, assuming that we have this intensive margin that may be driving something, how do we look at whether there is indeed an effect of this this stronger common ownership between banks and fossil fuel firms on loan pricing? And this is why it's even more preliminary, this part of the analysis, but let me tell you where we are currently. So what we do, we regress, we take now loan syndicates, so we only look, of course now the sample is completely different, we only look at the firms and the banks, both fossil fuel and others, that are within the syndicate data set, the syndicated loan data set. And what we have is that we regress the loan price, and this is a spread over the LIBOR, on a number of variables, as you see here. So we have common ownership. What is gone? Common ownership. Then we have our fossil fuel firm dummy again. We have our measure of climate risk measure. Then now for the moment, we only focus on Paris, but we are doing also the result for the environmental policy index. And then we have a number of interactions. What we are really interested in is to see whether common ownership has by itself an impact on loan pricing, and whether in particular one would do the triple interaction with fossil fuel firm and the before and after Paris, whether this has an impact as well. So that's what we are doing, and again, we have a bunch of controls and a bunch of fixed effect. So what do we find? We find that here, again, look at this one. So irrespective of how we measure common ownership, we have that the common ownership, on average, tend to reduce loan pricing. So that indicates that common ownership, so why do we have this phenomenon of common ownership? So having common ownership between banks and firms indeed change the loan pricing condition. I think that is already something that is interesting, again, in itself, that common ownership has an impact on loan pricing. And in general, we see that for fossil fuel, you see that prices tend to be higher. But after Paris, they try to be lower again. So again, fossil fuel prices tend to be higher than, prices of loans to fossil fuel companies are typically higher than prices of loans to non-fossil fuel companies. But after Paris, we see a reverse. So after Paris, there are lower prices than before to fossil fuel firms. And that is something that, again, we shouldn't have expected. Somehow the risk of these companies, ceteris paribus, even only for the policy measures that have been taken, should have gone up, and banks should have priced these loans accordingly, possibly. And instead, through the measure of through the mechanism of common ownership, we find that the loan prices are instead lower for these companies. So this is where we want to ultimately to go. I see that I'm even earlier, Agnès, you will be happier. So let me conclude. So this was really a snapshot of what we are trying to do. So the main result so far is that the common ownership between banks and fossil fuel is typically lower, and is even lower after there are policies up there that become more stringent, being Paris or being the Environmental Policy Index. But this result is driven on extensive margin, mostly. That is, if there are no ties, there are no ties even after. But on the intensive margin, we see instead that if there were ties before, these ties become stronger. And these are the ties that possibly lead the decline in loan prices after the Paris Agreement relative to before. So of course, as I said, this is super preliminary. So let me just give an idea of what we want to bring this further. So of course, we want to use the Environmental Policy Index also for the syndicated loan analysis. We would like to, as usual in corporate finance / financial intermediation, we want to come up with more exogeneity issues. So we want to instrumentalize the Environmental Policy Index in some form. We want to reflect on the use of other common ownership measures. As I said, at the moment, we are just following the literature, and we look at common ownership as the sum of shares in banks or in firms. And the only, if you want, measure that put the two sides together is the number of investors, but I think we would like to come up more with a sort of more synthetic measure that takes both sides into account. And of course, we need to understand better the mechanism. It's not enough to say that they have common shareholders and therefore loan prices may be changing. We would like to understand, but I'm sure Eleonora will come with a suggestion in that respect, which would be most welcome. But this is where we are, and let me say again, we thought this was an interest in itself just to document this time series, if you want, of common ownership, and in particular to see that our desire of seeing more distance between the financial industry and the fossil fuel firms maybe is not there. Maybe these ties, in particular in cases where there were already these ties before, actually strengthen rather than weaken. And let me stop here. And I forgot to say, this is a joint work with Anja Duranovic, who is a PhD student in Utrecht, Irene Monasterolo, and Steven Ongena. Thank you.
Thank you very much, also for finishing on time.
I gave you some freedom.
So, Eleonora, you can get this 3 minutes extra for your discussion. So
thank you very much.
You have 10 plus 3.
All right. Well, first of all, I want to start by thanking the organizers for having me here. I really appreciate the invite. And introducing myself. So my name is Eleonora Sprappini, and I'm at the University of St. Andrews. And although I have 3 extra minutes, in the interest of time, let me just start. All right, so what I want to start with is by trying to reframing or remotivate the paper from the literature that I'm most familiar with, right? So this paper is really about lending, it's about transition risks, and it's about common ownership. And if we at least stick with the first 2 of these 3, there is already a lot of literature out there. So there's papers that point to the fact that banks adjust their pricing, they change their credit allocation, they change their securitization choices based on changes in transition risks. And also there's a lot of papers that point to the fact that different banks do this differently, right? So for example, here systemic importance matters for banks' adjustment, but so does portfolio exposure. Green lenders lend differently to green firms. The geographic location of the banks matters, at least insofar as the regulatory stringency of the environment in which they operate, but also maybe or may not banking climate commitments matter. Here, the literature is a bit split. So given this context, it's not too crazy to ask the next question, which is, well, does common ownership matter too? And this is exactly what Elena and her co-authors are doing, right? If we have a borrower and a lender which share common owners, does this lead to a differential adjustment in lending when there is a shock to transition risks? And this is essentially where this paper is going. And Elena already presented her first results, but let me go through them again relatively quickly. So in the first part of the paper, they really focus on whether there is an effect of a change in transition risks on these common ownership relationships. And what they find is that common ownership between banks and fossil fuel firms increases less after a spike in transition risks relative to the common ownership between banks and other firms. They also find that common ownership grows faster between banks and fossil fuel firms, but new relationships are less likely. And in the second part of the paper, they move on and they say, okay, there is this common ownership relationships, right? So now, what happens if there is a shock to transition risks? Does this lead to differential changes in lending? And the early results point to, yes, this is indeed the case. And in particular, if we look at fossil fuel firms, they seem to be getting a preferential treatment, so relatively lower spreads from banks with which they have a common ownership relationship with after an increase in transition risks. So what I want to do with this paper, since it's so much at the early stages, is try to take the next step for the authors and try to think about what are potential mechanisms that might explain the results that they're seeing. And in particular, if we take a look at the first part of the paper, I think one potential story that might fit what they see in the data is the idea that when there is a spike in transition risks, you're going to have institutional investor perhaps shifting more towards less exposed assets. And here, what's important to keep in mind is that banks themselves are less exposed assets, right? The finance sector is a low carbon sector. So after Paris, then it's not too surprising to see that investors are more likely to invest in banks and other firms. If you have an investor invested in fossil fuel firms, then it might diversify at a higher rate. And new bank and other firm relationships are more likely to pop up vis-a-vis relationships between banks and fossil fuel firms. All right, so this might or might not be the mechanism here, but I think it more or less fits what you're seeing in the data. But even if this is the story, right, I think the interesting point that you also made in the presentation is that this common ownership is increasing in time, right? So where the paper really gets interesting, I think, is this next step that you're trying to take, which is, okay, what is the effect of common ownership on lending? And what you're finding right now is this lower spread after Paris. And if we start to think about what is the potential effect of common ownership in this context, the first thing that comes to my mind, at least, is that if you have a lender and a borrower sharing common owners, then the lender here is going to face lower agency frictions, lower information asymmetry, and at this point, if you have a shock like Paris, which raises transition risks for fossil fuel firms, and we know from the literature that this means that lenders are pricing higher the loans to fossil fuel firms, then if you're a fossil fuel firm with a relationship, a common ownership relationship with a bank, you're going to go to that bank because that bank is going to give you relatively lower costs because of these lower agency frictions and information asymmetry. So common ownership here can mitigate this effect. And in a way, this would not necessarily be a negative, such a bad thing. It could almost be a brighter side of common ownership in this context. But we might come up with an alternative explanation for what we're seeing, which is the idea of perhaps investor pressure. So here you could have either directly or indirectly banks being pressured to protect the other investments of their common owners, right? This would not be such a different story relative to the incentives which come with portfolio exposure or asset overhang and the whole zombie lending type of literature. And this might be instead a darker side of common ownership. And we could test this, or I mean, you, Elena, and your co-authors could test this. You could perhaps look at the performance of these loans, and I know this is difficult with DealScan. So alternatively, what you could do is look at the performance of the borrowers exposed, because if it is lower, then this might be more of a story of investor pressure. And then once you get there, I think there's so much else that you can look at. One thing would be relationship development, right? If you do indeed have a new link, a common ownership link, does this mean that a new loan is more likely? What about different heterogeneity in investors, right? If you do have sustainable investors, is there a differential effect here on lending? What about linearity? I know you said you looked at different thresholds, but at what point does it really start to matter? And the last thing that I want to do here in the presentation is ask one final question, Ria. Is this really a story about fossil fuel firms, or is it maybe a story about the other firms that you're talking about, those greener firms? Because when I made the point about the first part of the results, I really said that, well, it could be that investors are shifting towards these other firms, which might explain what's going on. But I could make a similar argument when it comes to the second part of the results, right? Because if we think that after Paris, these other firms, the greener firms, are now having better opportunities, that might lead to an increase in demand for credit for these firms. And if these firms were already getting lower spreads from their common owners, relationship banks, then at that point it might make sense that they demand more from them, which is driving relatively higher prices. This would still be a common ownership effect story. This would still be a story about common ownership, transition risks, and lending, but it would be a slightly different story. So let me just conclude, also on time for Agnese. And what I want to say is that I really like where this is going. This is an interesting direction to take. Is there still a lot to do? Sure. I'm not claiming that this is perfect yet, but I really like the direction. So I'm looking forward to reading a draft of this paper when there is one. And I will leave all the other smaller points and more boring points about specification and samples for you to read later.
Thank you, Eleonora. Elena, would you like to respond?
Yes. So first of all, thank you very much. This is super useful for us. I think I like a lot, first of all, it's typical, in particular in early work, that the discussant is much clearer than the presenter. So thank you for rephrasing the story the way you did. But I like the way you have phrased the potential mechanism behind. I have to say, I tend to think that what's driving it is more that once a shareholder has an investment in fossil fuel, is a sort of sunk, and therefore tries to make this more profitable for the shareholders. Otherwise, it would be, now there is Paris, or there is anyway a more stringent policy, and this investment loses value. So the way to preserve the value of this investment, eventually, from the perspective of the shareholder, because we are used to think about bank perspective, but this is really the shareholder that is influencing, assuming that there is this influence. So in a way, the shareholder, instead of risking to lose the value of the investment in the fossil fuel, tries to make it more profitable still by starting investing in the banking sector more and trying to affect the way the lending goes through, in particular on the pricing issue. So, and coming to the second hypothesis you sort of put forward, which is maybe is the more the demand of the other firms. It could be, but then it wouldn't be consistent with the first part of the paper. So if you put the first and the second, I would tend to think that is more, if you want more the zombie lending story, that once, but from the shareholder perspective, not the banks, so that if you have this investment, either you sell it, but you may make losses, or you try to preserve as much as you can. And the way you do it is by investing more in banks and potentially influencing the lending. But this is all to be tested more. But thank you for phrasing the way you did and for the suggestion. Very useful.
Thank you. So we have time for opening up to the floor.
Oh, well.
Very interesting stuff. I wonder whether you can do better than just having pre versus post Paris, since you're looking at the US and there has been big changes in attitudes towards Paris over time. I know you have this other index, but perhaps you could look at this more explicitly. And also, could you look more at explore heterogeneity across banks? So banks that have greater European shareholding versus US shareholding, where the attitudes to Paris are different. Thank you.
Very interesting project, Elena. I have two comments or suggestions. So the first, I was wondering whether you can get information on the type of investment that these brown firms are undertaking. Because suppose that the brown firms are trying to become less brown, in principle then, I mean, banks may want to lower interest rates because these investments are making the banks safer. And in addition, from a social planner perspective, this can be good because we would like to have lower cost of capital precisely for the firms that are undertaking investments for the green transition. The other thing is on the measure of common ownership. Maybe you could explore with the shared board members, so interlocking directors. This is a slightly different concept, but this can be like a symptom of common ownership. And can be synthetic, no?
There are a couple more questions on this side. And yeah, okay. Do you want to respond first? And then
yeah, maybe I just, before I forget. So yes, Beata, we can exploit it more. I mean, this environmental policy index go closer to this change in attitude, but we can try more, in particular because we are looking at the US indeed. Shareholders, absolutely. You say US versus Europe, because indeed we have, for example, Deutsche Bank that could be very active in the US, but of course a much more European banks as charter at least. But what we also thought of doing was to look more at the heterogeneity of the shareholders, if they are active, if they are passive, if they are short-term investors, if they are long-term investors, and stuff like that. So definitely yes. I think, Enrico, you raise an interesting point on the transition of this fossil fuel. I mean, from the bank perspective, I think we shouldn't underestimate the difficulty that banks may have in financing the transition of fossil fuel firms. Because yes, they may, and ultimately they do better. I mean, they improve transition risk, and they make these firms more green. But in financing these firms, they are still subject to all sorts of reputational risk, NGOs consideration, and everything, which may not see the same way. So while I take your comment, it's very difficult for banks to actually finance this transition to fossil fuel industry. But these are interesting suggestions, also the interlocking.
I saw two more hands on this side, and there was a question on this side as well, so yeah, you can take three more.
Hello, thank you. I'm Philippine Courtiman, ECB. Very interesting results, and I would like to look at the intensive margin for firms when you have common ownership. There might be one explanation which I think is not explored, which is the price of oil for these production firms, right? We are here in the US, which is a producer of this fossil fuel energy. And typically, the fossil fuel firms will earn more, be more profitable when the oil price increase, and the others, it's the contrary. And the Paris Agreement took place at the end of 2015, entered into force a year after, at the end of 2016. That was at a time where the oil price had plunged. But afterwards it recovered, so maybe it could explain part of why you have more lending and lower prices to these less risky firms in the end, which are the fossil fuel firms in the US.
Let's collect the other question. There was Angela.
Hi, Angela Maddaloni from the ECB. I have a question. Since you're looking at like firms that are listed, if you have look at credit rating of these firms, this is also related to the question of Enrico, because credit ratings, if you believe that they should also incorporate some transition risk, they should maybe also incorporate the fact that firms are going from brown to green or something like this. And credit rating are also very important for investment in general. So institutional investor would decide portfolio allocation depending on credit rating. So this could be also a way where some of the mechanism could be explained.
Yes.
Last question, 1 second, because there was a last question.
But I would say thanks for both of these comments. For the oil price, we already thought of incorporating into the analysis, so we will certainly do it.
Okay. Hi, Beatriz González from Banco de España. I wanted to ask you whether maybe to dig deeper into this investor pressure mechanism that Eleonora was saying, you could think of majority ownership. and whether they have shared majority ownership, so that this can really push for changes in the behavior of these banks. And this, if you find this is stronger for this bank and firm that have this majority ownership that is shared, then this can be an indicative of this zombie mechanism that you were thinking of. Thank you.
Okay, I think we can give 2 more minutes to the next paper.
Wonderful. So thanks a lot. And we move to the third paper. We have Ye-Yun Rong from the New York Fed, shedding light on the credit card market in the US. And the discussant is Larissa Schaffer. Ye-Yun, you have 25 minutes. How do I get back to the first page? No?
Okay, great. Thank you so much for having this paper in the program. My name is Hae-Yun Jung, and I'm very excited to present my paper, Credit Card Banking. This is joint work with Itamar Wei-Yu and Guan Yu at Wharton and Dominic from Columbia. And I'm at the Federal Reserve Bank of New York, so the usual disclaimer applies. The credit cards are central to consumers. In the United States, 3 out of 4 adults are having a credit card, and 70% of retail spending is made with credit card. And what's surprising is that a large share of credit card users are borrowers rather than transactors. So 60% of credit card accounts, or 85% of balances, are borrowers. So what this means is that credit cards are not just a payment tool, but it's also the main source of borrowing for consumers. And then what this means is that credit card rate determines their marginal cost of consumptions. And we show that this rate is very high. Credit card rates are very high. The average annual percentage rate, APR, on credit cards in 2023 was 23%. And this is 18% above the Fed funds rate. And these spreads are much higher than the spreads on all other loans or bonds. For instance, C&I lending is only about 2%. Mortgages are 3%. And even high-yield bonds have 4%. And you can see that credit cards are having 18% of spreads. And you might think that these are driven by the households having low FICO scores. However, we actually show that credit card rates are very high for all FICO scores. What you see here is the effective interest spread on the y-axis across different FICO scores at origination. And you can see that even the highest FICO of 850 pays about 7% of interest rate. And across all these FICO scores, we find that the average spread is about 14.5% in our sample. And we are going to decompose this 14.5% into different components to understand what's driving this high interest rate. So because of these high interest rates, credit card lending generates high profitability. Banks make 16–17% of banks' interest income from credit cards, and it constitutes only a small part of bank balance sheets. And of course, at the same time, credit card lending is the riskiest form of the lending that banks do because credit cards are unsecured consumer lending. And on average, more than half of banks' annual default losses come from credit card lending. So credit card lending is risky and profitable at the same time. So here are our research questions. First, we ask this question: why are credit card interest rates so high? To answer this question, we analyze credit card lending as an asset class, and to understand the pricing of the credit card rates. And we compare these pricing to other types of lending, for instance, corporate bonds. And second, what are the economics of credit card banking? To answer this part, we investigate all streams of revenues and costs, and we think about whether there's a market power in credit card banking, and how does it relate to the pricing of credit card rates, which is going back to the first question. So why are credit card interest rates so high? We have 4 potential explanations. The first is about the expected credit losses. If the expected credit losses are high, to compensate for that, the interest rate could be high. So that's our first hypothesis. And the second is about reward costs. These days, credit card companies offer various benefits like cashbacks and mileage, and that could be costly from the bank's perspective. And to recoup those large reward expenses, banks might be charging high interest rates. So that's our second hypothesis. And we know from the literature that banks can have pricing power because of imperfect competition or search and switching costs. So our third hypothesis is related to the market power. And our final hypothesis is about the risk premium. If default risk is not diversifiable, and if the risk tends to go up during the bad times, then the risk should be compensated. So that's why the credit card default losses can carry a high risk price. So I'm going to go over each of these potential explanations. And how do we test the hypothesis? We use Federal Reserve regulatory data, Y14 data, which is used for bank stress test. And we have data on, we focus on the data on domestic credit card operations of large US banks. And this is a very comprehensive data set. We have 20 banks in there, which accounts for more than 90% of all US credit card lending. And it's very granular. It's at the account level, and the data includes the rate, interest rate, APR, balance, fees, interest, purchase volume, rewards, promotional status, and then borrower characteristics like FICO score and borrower income, and we also have credit limit. And we complement this account level data with the portfolio level data, which covers these variables. And we end up with 330 million observations per month over the sample period from 2015 to 2023. So here's our approach. So how do we make use of the data? We track lifetime performance of accounts originated between 2015 and 2017. And then we examine all the revenues and cost components, including interest, charge-offs, interchange, fees, rewards, and operating expenses. And in each month, we make distinction between borrowers and transactors. This is important because they're very different. Borrowers carry balance and they have to pay interest unless they are under promotion. And on the other hand, transactors pay balance within the deadline, so they don't pay interest. And then our third step is we further sort these borrower and transactor accounts by their FICO bins at the origination. And why do we do this? A, because sorting on FICO at origination creates a large spread in default risk, so we want to exploit this cross-section. And B, APR spreads are typically set at the origination and based on the FICO score, and they don't change over the account's lifetime. So we use these FICO bin portfolios cash flows to analyze the risk and return of credit card lending. So let's start from the first hypothesis, going back to our research question, why are credit card rates so high? Our first hypothesis is because the expected credit losses are high. So we ask a very simple question, do credit card spreads equal the average charge-offs? And what you see on this green area, this is the net credit loss, and you can see that this chunk is big. So on average, the credit card charge-offs net of recoveries are high. We find that it's about 5.8% per year. And looking at the FICO cross-section, moving from the low risk to high risk, of course, it's not surprising to find that the net credit losses are bigger for the lower FICO score. And now let's look at the interest income, which is the blue part here. And you can see that this covers the entire net credit losses. And it also increases in the default risk. And because the blue part is increasing even more than the green part, the net credit spread, which we call default adjusted credit spread, which is the black line on the right axis, this one is strictly positive across all FICO scores. So what this means is that even after subtracting, while the credit card charge-offs are high, even after taking this component out, there is a substantial part of the credit card spread that is not explained by the expected charge-off rates. So that was testing our first hypothesis. And then what else can be there? We thought about the rewards cost because banks offer various rewards like cashbacks and mileage. That could be costly for banks, and the high credit card rates may help recoup those high rewards expenses. So that's our second hypothesis. And what do we find? We find that banks do spend a lot on rewards. They spend about 1.6% of purchase volume. But we find that this is actually fully covered by the interchange income, which is the swipe fees that the banks collect for each swiping of the credit card. And that's about 1.8% of the purchase volume. So taking the both sides into consideration, the interchange rate net of rewards, which is green line here, we should read it from the right axis, is positive across all FICO score for both transactors and borrowers. What you see on the left-hand side, this is the transactor count, and the yellow part is the interchange income. The purple part is the reward expenses. The green is the net, and you can see that it is strictly positive across all FICO scores, and the same message from the borrowers as well. So what this means is that rewards do not really explain the high credit card spreads. So that was testing our second hypothesis. And then we thought about market power and operating expenses. So while examining all the income and expense components of credit card business, we find that the credit card banking involves high operating expenses. They spend about 4.85% of balances, and this is much higher than the average commercial banks, which typically use about just 1% of balance in the operating expenses. And among those operating expenses, we find that the banks spend a lot, especially on marketing. So for instance, Capital One spent $4 billion, and American Express spent $5.5 billion in 2023 in marketing. And these are comparable to Coca-Cola and Nike, which are the largest marketers in the world. So why are they doing this? What we have in mind is that high spending on operations or marketing helps drive customer acquisition, and that they help build market power. And we have a suggestive evidence supporting this idea. We find that banks with higher operating expenses charge higher interest spreads. So what you see here is the borrower interest spread on the y-axis, operating expenses on the x-axis, and these are bin scatter plot from the bank and FICO bin level. So one dot represents can represent different banks for different FICO bins, but you can see that the relationship is positive and significant, and this is already after controlling for the FICO fixed effects. So what this, I can show you the regression results as well. So if we regress the interest spread on the operating expenses, we find that the coefficient is positive and significant, and the same idea for the gross margin. So what this means is that banks' operating expenses are strongly related to the interest spreads and the gross margins, even after controlling for the FICO score. So it makes sense to think that operating expenses are incurred to obtain the pricing power. And on the third column, in contrast, when we regress the net charge-off on the operating expenses, we find no relationship. So this suggests that higher operating expenses are really for marketing to obtain the market power, not for improving the screening of borrower creditworthiness. So that was related to market power, and now we put these pieces together, and here are the different components of the credit card banking business. The blue, red, and green parts, these ones are the parts that you've already seen when we talked about the first hypothesis. And then we add on the yellow and blue parts that you saw from the second hypothesis. And after netting these out, we get this net ROA, return on assets. That's the black line on the right-hand side, right axis. And on average, we find that the ROA is very high. It's about 6.8% for the aggregate portfolio of borrowers. And as a result, at the bank level, credit card banks can earn about 3 times the ROA of the average bank. And what's interesting is that the ROA increases in default risk. So ROA increases from about 5% for the 800 FICO guys, and 8% for 660, and then almost 11% for 625. So this ROA increasing in default risk suggests that there could be default risk premium. So that's going to be our last hypothesis. So if the default risk is not diversifiable, and if the default risk tends to go up during the bad times, the risk should be compensated. So what you see here is the charge-off rate of different asset classes, like credit card, consumer loans, C&I loans, and mortgages and corporate bonds. And you can see that the credit losses tend to move together strongly. And the shaded areas are the recessions, and you can see that the credit losses tend to move together, and they tend to go up during the bad times. And the black line, this one is the credit card charge-off rate. And you can see that it is the highest and the most sensitive charge-off rates compared to other loans and bonds. So this again suggests that the high ROA of credit card lending may be coming from the default risk premium. So one message here is that the banks cannot diversify this risk by investing in different types of assets. And even within the asset class, even within the credit card asset, across different FICO score, that's what you're seeing in different colors, the charge-off rates move strongly together. So this gave us an idea that these charge-off rates load on a common default risk factor in credit card market, and different FICO bins can have different sensitivity or beta to the common risk factor. And the lower FICO portfolios, charge-off rate is higher and more volatile, so we're going to find higher beta to the common risk factor. So taking this idea, we estimate a one-factor model of deferred risk and risk premia. How do we do it? We estimate a time series regression as the first step for each FICO bin. So for each FICO bin I, we regress the change in charge-off rate on the aggregate change in aggregate charge-off rate as a proxy for the systemic default risk. And we're going to obtain the beta for each FICO bin. And what you see here on the blue line is charge of rate on the left axis and the beta on the right axis. And you can see that the charge of beta goes up as the FICO bin goes down, as the default risk goes up. And this is pretty much linear, so this is consistent with the idea that the FICO portfolios has a strong one-factor structure. So we take these beta estimates, and then in the second step, we estimate the default risk premium. So here, this is a cross-sectional regression. We regress ROA of different FICO bin, I on the beta coming from the previous step, and the gamma is going to be the price of default risk, and gamma times beta is going to be the risk premium. And what you see in the blue line, this is the credit card ROA, and the black line is the fitted ROA coming from here. And you can see that the two lines are close to each other. This means that the model fits very well. And in terms of the estimates, the gamma is the price of default risk. And we find that the aggregate default risk premium is about 5.3%. And lambda, the intercept is 0 beta rate, and we find that it's about 2.4%. And interestingly, we find that this is close to the transactor portfolio, which is very low default risk, which is about 2.6%. So we find that this adds validity to our estimates. And what if we compare this, this risk premium to the overall banking sector? We find that the overall banking sector's default adjusted ROA is about 1%. So comparing these 1% to the 0 beta rate, we find that the credit card lending earns about 1 to 1.4% relative to the overall banking sector. And we also compared these numbers to other types of assets. In particular, we thought about corporate bonds. And what you see here, these are the same black and blue line. And the purple line is the gamma times beta, the risk premium of the credit card banks. And the green line, this is the risk premium of corporate bonds by mapping the bond ratings to the comparable FICO scores. And you can see that they're pretty much in line, especially for these B to BBB rated bonds. But for the lowest bonds, we find that there is about 3% gap. So putting all these components together, here's the decomposition of the credit card spread. The alpha, this is what I just explained. The credit card banks are earning about 1 to 1.4% higher return compared to the overall banking sector. So alpha is contributing to the high interest rate. And these three components, the operating expenses, risk premium, and charge-off, these are also important components explaining the high interest rates. And if you add up all these numbers, we go back to the 14.5% that I showed you in my first slide. So to conclude, the credit card interest spreads are far higher than those on other types of loans or bonds. And there's a large cross-sectional difference in FICO portfolio ROAs, which can be explained by a large default risk premium. And as you can see from here, charge-offs, risk premium, and operating expenses are the important components. And as a result, credit card ROA is more than 4 times higher than the banking sector average due to the default risk premium and alpha. So this concludes my presentation, and I look forward to Larissa's discussion and also questions and comments. Thank you.
Okay, so first of all, thanks a lot to the organizers for inviting me to present this to discuss this very interesting paper that I enjoyed reading a lot because, I mean, it gave me a great overview of a market that has not been studied yet. You have also a lot of observations, like the first paper today, 800 million, 300 million, so great data set. And I'm going to focus a bit more here, generally summarizing the paper and then giving you some suggestions, since the paper is already very long and very detailed and you've done a great job already, how you could explore more some of those channels. So what is the paper doing? You're asking two questions. On the one hand, why these credit card interest rates are so high? So you present different channels, right? So is it the operating expenses? Is it the charge-off rate, interchange rate, or is it basically default risk? And then the second part of the paper is trying to understand sort of what are the factors explaining this, where you present also this default risk premium model. You have a great data set, as I already mentioned, of 330 million individuals, of 20 largest banks that even to other statistic accounts, even to 95% of the total market, which is quite great. What are the main findings here? So you find first that the default rates explain only 5% of this sort of around 23 or 18% spread in credit card rates. So it's only a small portion, which is very surprising. Then we have the non-interest income that offsets the expenses, so there's not much here in terms of contribution to the high interest rates. You have the large operating expenses, where we'll go on more in detail here, and then you have the still 6.8% ROA, that is even 4 times the banking sector ROA, and when you build this default risk premium model, you still end up with amazing alpha of 1.17 or 1.44%, which is great, so it seems to be a very profitable business. So overall, my first general assessment of the paper, I think it's a great paper. It gives us insight of a completely new sort of market, right? First empirical evidence on determinants of these different interest rates with this granular data, and then the economics of the credit card banking, which you even call just a bit in the paper, the credit banking franchise, where you could maybe even expand it even more. I think in your paper, in the presentation now, you also didn't do it, but I think you could even call it credit card banking franchise, because I mean, it's amazing what the premium they're making. So you have this unique data set, and what am I going to mention, to focus on was more on this market power channel, because so far you're looking more sort of at the expenses, but less on the interaction with the borrowers. Then you sent me already the previous, the updated version of the paper, where you actually already explore sort of more the dynamics of the profitability, which I actually had also as a discussing point, and general implications of this paper. Given that you have this amazing data set, you also have not just the FICO score, but also income and geography, which I think you could explore even more to make broader statements about how it affects consumers overall. Okay, so here this is a graph actually not from a paper, but from the Federal Reserve and the Consumer Protection Agency. So I read an article on this market here. So as you mentioned, right, charge-off rate, non-interest income do not explain much. And this is also amazing to see in this other plot based on other types of data here, right? You see the APR margin is increasing since '95, despite the low interest rates. I mean, I find it's incredible, especially in this time period. And the charge-off rate is going down, and the spread is widening, which also is very surprising, right? And then among the costs you studied, the main one you're suggesting is this marketing expenses, which is as large as large firms here. And the interesting chart that I also found from the Consumer Financial Protection Bureau, they show the market share of the top 10 issuers, which is in green, and then the next 20 issuers, which also stayed relatively constant between 2016 and 22, right? So the spread is widening here, market power stays relatively constant. This is not related to the marketing expenses. So I was wondering whether you could do a bit more, trying to show what is going on with this market power and also sort of the franchise that they have relative to the customers. And here I'm relying more on the banking literature for firms, where often it has been shown that banks sort of misuse or use sort of the credit registries to see more or less about borrowers. And here I found similar evidence from the credit bureau, where basically they say that banks are not sort of only spending a lot of marketing efforts here to retain or attract new customers, but also they're trying sort of really to grab these customers and not make it possible for them to switch banks, because they're basically engage in this new practice of withholding monthly payment status. So it's basically the opposite of what Manju was presenting, is closed banking. So they're really trying to hide data to make it even harder for customers to switch. And I think this is also very interesting angle, given the fact that you find that the most spread that they're making is exactly in this low FICO score, probably also low financial literacy segment, and this is probably where they're able to exploit it the most. So you can do more on that, showing sort of more results on this data set, who are the banks that are engaging in that, and then also to see more sort of over time within the customers, what's the churn rate, is it the existing or the new customers they're trading, what is driving this sort of marketing power. So far it's just operating costs, but you mentioned the switching costs and so forth, but I think you can do more here. Sort of what constitutes the strong pricing power that they have. You could also exploit here the age and the income. And the last part, which surprisingly I didn't find anything on, there is no effect of new entrants affecting the margin on entering. So they should be entering as of 2020. Maybe the US market is different. Other forms of credit card banking, that would be also interesting to see, I think. Then the last, my second comment was, which you already addressed. I was also interested to see, since mostly you focus on the distribution across FICO scores, to see over time how is it affected? How did the great financial crisis play a role? Which, I mean, you have a plot here in the back where you show it does fluctuate a lot. So in red, you see here the return on assets for the credit card banks, whereas for other commercial banks in blue is relatively stable, but you see sort of this blip around COVID, which would be also an interesting period to exploit, which you have in your data set. And here also I find that the data set is sort of focused on the largest banks, and it seems the period that you're using, 2015 to 17, is basically a period where, as I showed in the previous graph, also from this Federal Reserve Consumer Financial Protection Agency, where you have this widening of the gap. So you might be picking up a period where they were extremely successful and extremely good at reaping off their customers, focusing on the largest banks. So maybe you should try to show a bit more. Is it really maybe the top 10 that are basically effectively dominating 86% of the market, that they are the ones contributing to the most of the effect, right? So you see nicely here the margins, prime rate relative to PA margin did increase amazingly exactly in your period, which is like around 2015 and 23. And then lastly, broad implications, because I also want to be on time and I don't want to stand between you and lunch. Here I was thinking about more the broad implications, because surprisingly, even when you look at the default risk premium, and you try to sort of plot it, connect it to your distribution of ROAs, which you see here in black, somehow this blip between the prime and non-prime customers you're not able to capture. Also, when you look at the expenses, right, they're all relatively linear, and I was wondering how much you can exploit here around the prime and non-prime. You could do more. And then I was thinking even more, right, what are the general implications here of this higher credit card rates in terms of geography and income for welfare implications and sort of serving or exploiting the most underdeserved customers, which you could do probably. And here it would be interesting to see, are they able, and this graph suggests this, especially the undeserved one are the ones that are probably exploited the most, and maybe there's some cross-subsidization. There's a paper by Andres Silva, I think, that exploits that is going on here, where the banks are sort of trying to reap the benefit. So I have 70 seconds, right? So I'm trying to be on time. So I think it's a very interesting paper that really gives us a new perspective on the economics of credit card banking. I would like to see more on market power, but I think it's in general, it's a very interesting read. And good luck with the paper. Thank you.
Thank you. Would you like to have a couple of minutes to reply, and then we open the floor for questions?
Yeah, sure. Thank you so much for your thoughtful comments. I like all of your comments. We will take them on board. Market power, ideally, we want to have a shock to market power, which we haven't found a good one, but there's going to be a large merger in the United States, so we might be able to do something there, but I like your suggestions. We will try those first. And the dynamics of profitability, why did the margin increase over time? That's exactly what we are working on right now. So we are pulling more recent data to understand which part of the revenues and costs are driving the higher interest margin. And prime and non-prime, the very sharp discontinuity there, that's actually our next paper. We are going to explain that.
Yeah, I was thinking you can exploit this,
exactly.
actually.
It's a good point that we also have zip code, so we have nice geography and other borrower characteristics we should be able to exploit. So we will take all of your comments on board. Thanks so much.
Thank you very much. So let's see a question over there.
Hi, very nice paper. I'm wondering how you're thinking about credit cards as an element of a banking relationship by which some of these extra-normal profits that you see in the credit card market may actually be compensating for the losses potential of a loss leader product. Which related to that, for example, think about debit cards that maybe banks may be losing money on them, but could be the entry point to later on offer credit cards, or think about apps, banking apps, that is like a common cost that serves the entire bank and needs to be covered with the profits of some arm of the banking activities. And related to that, on that alpha that you find for credit cards, as I understand, the FY14 reports interest charges at the account level. No, that is like how much a particular borrower is being charged on their monthly statement in terms of interest. But that's not always the same as interest revenue for the perspective of a company, because individuals that don't make the payments are charged interest, but that's money that never goes to the credit card issuer. So that's distinction between interest revenue for the lender and interest charges for the consumers. I wonder if it could be potentially explaining some of those extra-normal profits.
Do you want to respond first? And then it was an articulated question, and then we move and open up for a few more questions?
Oh, yeah,
you
sure. Just briefly, so I think what you're mentioning is captured by the operating, your first point is related to the operating expenses that we are, because we are capturing in terms of broad categories, we are capturing in operating expenses. I would love to hear more ideas about how to improve it. And I couldn't understand your question about interest charges and revenues. The numbers that we are showing is the effective interest charges. So how much the consumers paid is exactly how much banks received as interest income. So I wasn't exactly sure.
Sorry, the amount that you are charged when you don't pay, as I understand it, the FY14 reports the charge. So think of an individual that is defaulting on their credit card, every month is being charged a high amount, but that's money that doesn't come.
I don't think so. We are actually getting not just the charged, but the paid amount that banks are collecting.
Okay.
Yeah.
There was another question over there.
I love this paper. Thank you. Especially as someone who paid these exorbitant interest rates for some time. I really appreciated it. At the very beginning, you showed some other interest rates that look nothing like the credit card interest rates. But I would have liked to see the consumer loan interest rate among those. Right? None of those were, in any natural sense, substitutes for the credit card interest rate. Yeah, and I think there is a very nice analysis to be done whether other consumer loans behave similarly or not. I also would like to note that the argument about advertisement in operating expenses isn't very natural, right? You know, I spend a fortune on advertising, hence you have to pay me a lot, isn't the kind of marginal cost argument we usually have in mind. And so it's really in the alpha. If the alpha weren't there, they wouldn't be competing this way. They wouldn't be, you know, spending so much on advertisement, and therefore they wouldn't be seeing these operating costs either. So I think there is some very reasonable argument to be made to not include the advertisement bit of the operating costs in the overall operating costs, and to see that as something that is, you know, forked out by the consumer for no useful reason. Thank you.
Yes, thank you for your comments. The consumer loans, obviously we want to match it, but unfortunately we are not able to merge. Like if you have consumer loan and the credit card, we are not able to identify the same person, so there's limit to what we can do there. But of course, at the aggregate level or the risk premium analysis, we can try. So thanks for the comment. And the operating expenses, we will think about it a little more. Thanks.
Any more questions? Over there.
Hi, thank you so much for the presentation. This is super cool stuff. I have a question as well about the market power and the marketing expenses. I'm wondering in what dimension this is particular to the credit cards, and in the sense that if the banks have market power on the credit card segment, they would also have it, for instance, on the mortgages. So wouldn't it be something that you also see on other products? And is the marketing expense that you have in mind tailored to the credit card segment?
Yeah, that's a great question. Yeah, I mean, in theory, yes, but I haven't. I mean, we haven't done anything on that direction.
Any more questions? Oh, okay. Yes, there, Christina.
Hi. I wonder how much of the market power is coming from the fact that you have to, in the US, you have to have a credit card to have a credit history, establish a credit history, which is a really costly way of establishing a credit history. So I wonder how much market power this gives to these banks, as opposed to what we have seen in India, where in Manju's presentation, where there was a really cheap new method of establishing a credit history.
That's interesting idea. We haven't thought about it. I mean, on the top of my head, I'm not sure how we can show anything in terms of like quantifying how costly it is to build a credit score, and then how much of the market power is exactly driven by that we will have to think about it. But it totally makes sense that that's very relevant. We'll think about it.
Thank you. Any more questions? No? So maybe I can ask one?
Oh, sure.
Yes. So I was wondering whether you looked at the other side of the market. So there are the consumers on one side, the merchants on the other of the credit card, right?
Yeah.
And if this higher interest rate that they charge to the consumers mean anything, or have implication for what they charge or offer on the other side to merchants?
Yeah, but merchants, we don't have we don't have data on, we have nothing on that side.
Okay.
So that's quite unfortunate. Yeah.
Okay, too bad.
Yeah.
But so I think we can close here this very interesting question. So I would like to ask you to join me in a round of applause for all our wonderful presenters. It was really
So welcome everyone to this afternoon session. It's a real pleasure. Very excited to have very good two papers and discussions on firm productivity and firm dynamics. So the first paper is going to be presented by Professor Rafaela Sadum from Harvard Business School. And the discussant will be Juanita Gonzalez from LSE. So Rafaela, 20 minutes, the floor is yours.
25.
25, sorry.
Okay.
25, sorry. 25.
Okay, great. Thank you so much for having me. It's really a pleasure to be here. I'm going to present a paper that is joint with Amanda Dahlstrand, David Laszlo, Helena Schweiger, Oriana Bandiera, and Andrea Pratt. And you will see this paper is a little bit different from what we had this morning. This is a paper that speaks to managerial capital and the importance of managerial capital for firm productivity. So let me just first set up the motivation. Firms are obviously key for economic development, and CEOs are key for firm productivity. Now, we have evidence from high-income countries that suggests that there may be a causal, even a causal relationship between the identity of CEOs and the performance of the organizations that they lead. In earlier paper that Oriana, Andrea, and Stephen Hansen wrote a couple of years, more than a couple of years ago, but whatever, a couple of years ago in dog years, I guess, we also showed that it's not just the identity of CEOs that matters, but it's the match between the type of CEOs and the needs of the organization. This paper that we wrote was only about 6 countries, 4 countries that were developed and 2 developing countries. And since that moment, we sort of started mulling around some open questions that we wanted to investigate. The first one is whether the behavior of CEOs, for which we have evidence that comes mostly from high-income countries, could we establish similar relationships, similar evidence also for middle and low-income countries? And the second one is whether this issue of matching of the managerial talent and the needs of the organization followed similar patterns as the one that we had documented in earlier work. This is not as straightforward as a research question to address for a couple of reasons. One is conceptual. It's unclear whether the same patterns of matching of firms and managers would be the same across different environments, specifically because the needs of firms may be completely different. And second, there is an empirical challenge. In the work that we had done earlier, we went to measure the diaries of more than 1,000 CEOs with extreme detail to the activity level. Every window that lasted more than 15 minutes was recorded for a week. And it's unclear whether you could follow that type of really detailed measurement at scale. So in this paper, we address these 2 issues in 2 ways. The first type of contribution is mostly empirical. We develop a parsimonious measure of CEO time use that can actually be scaled across many more organizations than the ones that we had originally studied. And we deployed this measurement in a survey of 5,000 manufacturing firms in 42 countries, most of which are middle-income countries. Just to give you a preview of the findings, we find, first of all, that there is indeed differences in the supply of what we call leadership type of CEOs. Those are people that high level, you should think of them as being coordinator of resources rather than strict operators, people who go down to check the operations of the firm. And we find that there are imbalances in the supply of this particular type of CEOs in poorer countries. We also find, and this is there is one thing to remember about this paper, is this finding, that this is really something, we also find evidence of greater mismatch of managers and firms in poorer countries. So this taken together would suggest that one way to think about increasing productivity is, yes, to increase the supply of human capital and of one specific type of human capital, managerial capital, but also thinking about improving the match between firms and managers.
And in fact, we do some counterfactual measurement, and we show that these mismatches can cause, perhaps is a big word, but let's say they are associated with about 18% loss in productivity for mismatched firms and 8% overall. So if you take these estimates if you put some value to these estimates, this suggests that the improvements in productivity from addressing frictions in the matching of managers to organizations could be a valuable way to increase productivity. So I'm going to go very quickly through the related literature, but there are several papers that have studied extensively the importance of CEOs for organizations. This is a literature that by and large started with a historical paper by now by Bertrand and Schoar that exploits the movements of CEOs across organizations to define managerial styles. And this is a paper that is built on the assumption that there is vertical differentiation in managerial quality and that managers can port their talent in the organizations that they lead. In our paper, the one that I just mentioned a few slides ago, we took a different approach. Instead of using CEO fixed effects, which is the variance, if you like, the residual in the performance that can be attributed to CEOs' decision-making and behaviors, we decided to do the crazy stuff. We decided to go and measure behavior directly. So this was the time use surveys that we've run, effectively scaling some techniques, shadowing techniques that had already been developed in the managerial literature. We decided to systematize them and use them across, instead of the original 5 organizations on which Mintzberg had, Mintzberg is a management guru. For those of you who have not had the pleasure of meeting Harry Mintzberg, this was a technique that was built on 5 people. We scaled it to more than 1,000. And from this work, that's where we derived the idea that there are different behavioral types across CEOs. I'll explain this more in a moment. In particular, the types of behavioral differences that we uncover using the detailed diary data combined with some machine learning techniques is that by and large, CEOs are divided in 2 types. We call them leaders and managers. The labels are entirely arbitrary. We attribute these labels based on, again, some managerial literature that makes the distinction between CEOs or managers more generally that are primarily dedicating their time to creating organizational alignment. So think about the coordination function of bringing different experts together or building consensus, putting significant investments in interpersonal communication versus CEOs, in our case, that are much more involved with the operations of their firms and that directly, for example, give orders on the shop floor in the case of manufacturing firms and are mostly about monitoring the operations of the organization. This is a little bit similar to the notion of delegation. Managers who coordinate the work of others versus managers that do the work of others directly. So in this earlier work, we showed that there are differences in leader behavior. We showed that these differences matter for firm productivity. But in this paper, we tried to go one step further and extend massively the cross-section of countries in which we can look at this question. And in particular, we are very interested in the notion of mismatching, which is something that is different from the idea that there is only one type, one type of manager, and there is a vertical differentiation across managers. We are interested really in the matching of firms with firms. Sorry, of managers with firms. So the contributions are effectively 3. Thinking about extending the measurement of CEO behaviors, showing some more evidence on the matching, how the matching of CEOs to firms varies across firms, and then contributing hopefully to the literature on misallocation. In this case, it's not misallocation of tangible inputs, but it's a misallocation of managerial inputs.
So what's the setting for our study? We study 42 countries that are covered by the EBRD survey. These are countries that have a wide variation in terms of GDP per capita. It's about 10% of the world's population. And for our interests, this is a good setting because there is a good range of countries across different development stages. The survey data is the EBRD World Bank Enterprise Surveys. So this is a very high quality instrument that is where the data is collected through face-to-face interviews. It's a stratified random sampling of firms with more than 50 employees. And then we combine this information with our diary data that was collected earlier in 2016, I think. So this is the way in which we measure the CO time use in the survey data. As I said, it's face-to-face surveys with managers. The key piece of this data, how are we able to capture CO behavior in such a large sample? Well, effectively what we do is the following. We exploit the richness of the diary data, and we extract what are the variables that are most likely to predict leader behavior. And it turns out that at the end of the day, if you want to be very synthetic in your data collection, there are effectively 4 types of behaviors that are most correlated with this leadership index. And they are asking the amount in a typical week, how often does the top manager meet with the top echelon of the organization, how many meetings that involve the top managers include also other participants. This is to see whether there are meetings that are more than just beyond the one-on-one types of interactions. On the negative is whether the manager meets, how often the manager meets with supplier and how often the CEO meets with production. The last 2 are obvious. These are activities that are more likely to capture this operational focus compared to the first 2. Now, this is the benefit of going through these 4 measures is that, of course, you lose a lot of detail, but that's what makes it feasible to collect in large samples. So what we could do was include these variables in the EBRD surveys and get for a much larger cross-section of companies information on the behaviors of the CEOs. We use this data to create an overall CEO time use index. To simplify things, we create a binary leader variable that is effectively based on the median value of the combined 4 indices together. And it turns out that it's also quite close to the mean. So we've done a lot of robustness on how we simplify the construction of the variable. And this is not it doesn't really change much, the results. So I want to show you in the rich 12 minutes that I have 3 things. First of all, I want to give you a description of these leaders and the firms that they run. Some ideas of the matching patterns between high-income countries and middle-income countries, and then evidence on whether if there is mismatch between CEOs and firms and the quantification of this mismatch. Now, the ways in which we think about the mismatch is as follows. We know from we have both in the diary data and in the EBRD sample, we have a few high-income countries. Effectively, we treat this sample of highest income countries as our training sample. And so we derive a prediction based on firm characteristics. What are the firm characteristics that are most likely, that are most associated with the presence of a leader CEO? And this is our training sample. And then we go into the other part of the sample, our testing sample, the lower income countries. And the prediction that we derive from the training sample gives us an indication of whether that type of firm, based on its characteristics, should be assigned to, should be matched with a leader CEO. So it's actually fairly simple in terms of implementation. In the data, we find that the distribution of leader, this is just the raw data, the leader index in the training and in the testing data sets. This is an index that is normally distributed, quite simple between the testing sample and the training sample, although you can see that in the training sample, which is made of the higher income countries, this index is shifted to the right. They are more likely to find these leader CEOs in the training sample. The first result is just a replication of what we find in the earlier JP paper, which is that there is a strong correlation between the productivity of firms and the the presence of a CEO that is more likely to be, that is in our definition, a leader. This is the time use index. This is just to show you that the results hold in this new sample with magnitudes that are incredibly close to what we had found in the earlier work. And even controlling for other source of management capital, for example, the quality of the management practices adopted in the firm. The share of leaders increases with the country income. This is just another way to look at that distribution to the right that I was describing a moment ago. And the correlation between performance or size of the firm is quite similar between the testing sample and the training sample. Now, to get at this question of whether there is indeed a mismatching of CEOs and firms, we ask the following question. We ask whether firms that are predicted to have a leader end up having a leader, and what's their productivity. And we compare the productivity of these correct matches to the productivity of the companies that, at least in our methodology, appear to be mismatched. We get at the question of horizontal differentiation by looking at both the mismatches of companies that need a leader and are assigned to a manager, and companies that need a manager and are assigned to a leader. So this is telling us that it's not just, we effectively are testing whether, is it just one type of CEO that is associated with greater productivity, or is there more of a horizontal match that matters for productivity? Let me just skip, in the interest of time, the details of how we get at the prediction, but at a high level, we run a lasso that selects what are the company characteristics that are most likely to be associated with a leader CEO in the training sample. And then we use these variables to form a prediction of the type of CEO that the company should have based on the high-income countries' predictions. The key result that I want to focus on is the following. When we look at the correlation between productivity and this predicted leader propensity, we can distinguish between firms that need a leader and firms that need a manager. And then we summarize the mismatch in 3 ways. First of all, it's companies that need a leader but get a manager. So these are companies that typically are larger and need a CEO, according to our data, that is more focused on coordination tasks, but instead they get somebody who is very operational. We can also look at firms that need a manager but get a leader. These are firms that need more of this operational attention and instead get somebody who is more focused on the coordination tasks. And then finally, it's mismatch on a mismatch dummy that combines both these sources of mismatches. So here is what we see in the regression. This is a specification of the regression that I just described. Effectively, if a deviation from the predicted CEO type captures something that is suboptimal, then we would expect this to be reflected in firm-level outcomes. This is the regression. The dependent variable is log labor productivity. you can see the main result is that the mismatch is associated with a lower log labor productivity. These two variables are telling, opening up the mismatch in these two sources are both associated with lower productivity. I want to just stay on this result for a moment. This is what we use to infer that, in fact, there isn't just one type of CO that matters for firm performance, but what matters is the matching between the CO and the type of firm. In the rest of the, okay, so I want to show you just one more result that we leverage the results of this table to do some counterfactuals. And in particular, we are interested in understanding whether, what would be, sorry, let me just skip to, this is just the, okay, we want to do some back of the envelope calculation to quantify what is the loss in productivity that is due to this mismatch. So to do that, we calculate this, we use a very simple formula for counterfactual sales. The counterfactual is the sales of firms that are correctly matched. You can see that this is exactly the amount of sales that they have. These are companies that shouldn't be corrected, their matching should not be corrected. And then we calculate the counterfactual sales of the companies that were mismatched by using the losses, sort of compensating for the losses of productivity that we estimated in the previous table. The betas are estimated from the regression that the regression table that I just discussed. And what we find is that the sources, first of all, about 9% of the losses in sales could be recouped if we had no mismatches in the allocation of COs to firm. So that's first number is 9%, which is a pretty large number. The second thing that we do in the paper is to think about two ways in which these losses in productivity could be recouped. The first one is by increasing the supply of leaders. So that would be, for example, increasing the number of the people that are trained in business school. You should think about, if you believe that business schools create leaders, which I don't know if everybody believes that, but whatever. But that would be like, let's increase the supply of leaders, and then the other source would be, let's improve the allocation of people to companies. The supply can stay fixed, but we just improve the ways in which managers are allocated to firms. In our data, we find that about half of the misallocation, half of the loss in productivity is due to misallocation. And we have different ways of calculating this source of misallocation. For example, in the counterfactual, in one case, we take the supply of leaders as given, and we randomly allocate them to companies that are assigned to managers. In another case that would be more targeted, we rank the companies according to how badly they would need a leader. That's part of the prediction exercise. And so obviously, when you improve the match with this more targeted method, correcting for the misallocation has a stronger impact on productivity. The rest of the paper, which I will not discuss today, and it's something that perhaps will come up in the discussion, is our attempt of answering what I think is really the crucial question here. The first one is, at the firm level, why is it that certain firms get this match right? And so we have some evidence in the analysis that shows that companies that are more exposed to competition, companies that have better governance, at least based on the measures of board governance that we have in the BRD sample, are less likely to be mismatched. So we think that one margin here is to work on both the exposure to competition as well as basic governance measures. The second question is, what can we do to improve the supply of leaders? And so part of our exploration now is exploiting the presence of business schools across different countries, and in particular the timing of the arrival of business schools across different countries, to hypothesizing that that's one direct way in which you build managerial expertise. And so part of the analysis that we're working on exploits this variation both across and within countries in the availability of business schools, measuring, exploiting, in the case where we look at within countries variation, exploiting the distance of the business school from the firm. But I will not discuss this now. So let me just conclude. We have a lot of robustness. I would say that the first thing to take away from this paper is on the measurement side. It is possible to measure aspects of managerial capital, which is typically intangible, through a very parsimonious set of questions. And we think that this is actually quite promising from a measurement perspective. The second is that this distinction in managerial behavior matters for firm productivity. Obviously, we cannot establish the causality. These are mostly cross-country regressions, but in earlier work, we could at least use the assignment of the arrival of the CEO in the company and exploit the time series variation. And we believe that this is also important because it tells us that there is one channel that is related to the matching of firms to managers that could be relevant for firm productivity. And then finally, it's also the importance of thinking about not just vertical differentiation in managers, but also horizontal differentiation, which is something that is often missed in the discussions of CEOs and the importance of top management for organizations. So I'm going to stop here with some indications that these channels could potentially be quite relevant, at least if you believe our estimates. I'll stop here. Thank you. Okay. That was quick.
So thank you very much, Rafaela. And now we have Juanita from London School of Economics discussing the paper. You have 10 minutes. Thank you.
Okay, well, thank you so much for the organizers for reminding me to discuss this paper. I was telling Rafaela before that I read many of her papers, so it's a great opportunity to be able to discuss them. So thank you so much. Okay, so let me start with what I think is my take on this paper, and then I'll be more specific about my comments. There's basically 3 of them. Okay, so here's my view of this paper. So I think this paper is about providing novel evidence that there's at least 2 types of CEOs. Some of them are leaders, some of them are managers. And then understanding how mismatches between the types of leaders, the types of CEOs that managers should have and the ones that they actually have can help explain these differences in productivity across countries. Now, the way that they go around showing this is very interesting. So the first thing they do is they go back to their previous work by using like the CEO diaries. And then I think they do like a service to the profession, which is they simplify that very difficult way of really approaching how to measure CEO types by creating this questionnaire, which could be used by anyone that's really trying to do research in this area. And I myself am using that. So that is really something that I think it's a really great contribution from this paper, beyond showing some external validity from what they've done before. Now, having done that, this classification, then their main finding is that middle income countries, basically you have fewer CEOs that are leaders and more mismatches between the CEOs that firms should have and the ones that they actually have. And then they go around quantifying what's the cost of these mismatches and these issues in the economy, and they estimated around, I thought it was like 20% of productivity loss, the 18% that you were mentioning before. And at the final part of the paper, and Rafaela didn't have much time to talk about this, but I'll discuss it a little bit, they link this kind of like issues in the CEO market to missing high quality formal business education opportunities for individuals. Okay, so why do I think this paper matters, or where do I see it fitting within the literature? So the first thing is it's a new focus. If you look at most of the papers that have been written about CEOs, and specifically about their market and how much we understand, for example, how they're paid, they're typically written for a small subsample of firms, which are important, publicly listed firms, for example. But it's refreshing to see a paper that is extending that analysis to a wider cross-section of firms, and that also vary quite a bit in terms of size. They have a very interesting finding, as Rafaela kept saying. It's really important to understand that CEOs are not just unilaterally better or worse. You could think about different types at least, so managers and leaders. And when we consider the frictions along the market between firms trying to find the right type of leader, that can help us understand why is it that we see this difference in productivity across high income and middle income countries. So really interesting results. And finally, just the economic effects are striking. They're very large. So I think those are all very important reasons why we should care. And when you think about specifically the literature on misallocation, I think what this paper is doing, which is great, is shedding light on one particular type of misallocation. And I would call this kind of like, the CEO type misallocation that helps you understand these productivity differences. So overall, a great paper. You can see I'm a fan. Sensible story, really interesting results, easy to read, love it. 3 comments, first on interpretation, second on quantification, and then finally on the causes of missing leaders. So let me move on to my comments. So my first comment is on interpretation. I think this is conceptually the comment that I think is most important from the 3. And what I was thinking throughout as I was reading the paper is there is this notion in the paper where there's this idea that CEOs are of a particular type, and firms need a particular type of CEO, for example, at different points in their development. But what I kept thinking the whole time is that it seems a bit like the perception is that the type is something that is idiosyncratic from the perspective of the CEOs. But I thought, well, kind of like how CEOs behave is going to depend quite a lot on how else does the team that the CEO have looks like. In particular, I was thinking, CEOs, you could imagine they're going to have more time to be leaders if they have other middle managers to do the managing for them. And I think the reason why this becomes important in this particular exercise, when you're comparing high-income countries to middle-income countries, is that I think that in middle-income countries, and we have growing evidence of this, there is a lot of issues in terms of finding good middle managers. And so for me, I think one important conceptual question was, how much of what the authors are identifying as CEO style and CEO mismatches should be attributed not only to dysfunctions in the CEO market, but also in the market of middle managers. And so my suggestions here are really first, potentially just a broader interpretation. When you discuss the results, think about the manager as well as managing a team, and if the team is less or better, the CEO will have more or less time to be a leader versus a manager. I'm an empiricist, so obviously as much as we can account for that in some way, I would love to see. I think it's going to be hard. I can imagine that in the surveys, there's not going to be a great indicator of exactly what's the organizational structure of the firm. This is typically difficult to measure, but a few ideas come to mind. So I've done some work on this using Revelio data, probably not great for specifically manufacturing firms, but we could get indicators as of for certain countries. This is on average how organizational structure looks, how many layers the organizations have, and kind of correlate that with the exercises that they're doing. Likewise, perhaps some of the estimates in the paper by Hort, Malmberg, and Schulman, there could be another source to play around a little bit with the data. So that's kind of like my first comment, is about interpretation. Second comment is about quantification. I really like the exercise. So the comment here is not something about the methodology. My comment is coming more from curiosity. So if I understood correctly what was going on here, if you look at the prediction of which are the types of firms that are more likely to be needing leaders, some of the factors that were important in that estimation was first size, so the bigger firms are more likely to be needing leaders, and also some specific sectors. So I think the sectors were food and products, food products and rubber, where is it? No, rubber and plastics, sorry, office accounting and computing. And so I saw that regression, and then the paper also shows us that based on that regression, there seems to be not that many leaders in middle-income countries. And then what I wanted to know was, well, what were the factors that were driving that lack of leaders? Is it a size story? So is it what's going on that we have some largest firms, in these middle-income countries, and we don't have enough leaders for them? Or is it instead that this problem is concentrated in a particular sector? And if it's a sector problem, so imagine, the rubber and plastics kind of issue going on there. If it's a sector problem, then how much does it matter then when I think about high-income economies and middle-income economies, the representative firms in those sectors may be, for example, at different points or links within the value chain. Does it matter? Does it not? So I think it's more about scratching the data and kind of telling us exactly where that lack of CEOs is coming from, and providing some guidance for the reader to understand how much do differences across countries, for example, in terms of the average firm and sectors, matter for that comparison.
Likewise, when it comes to the actual quantification of how much we could potentially fix by basically randomly allocating CEOs to where they should be. So again, it's exactly the same comment. Depending on where the CEOs are missing, then the solution will entail, for example, taking CEOs that are leaders in very small firms and placing them in very large companies. Is it realistic to think that if you're a leader in a small company, would you be able to be a leader in a large firm? Or is it instead bringing CEOs from one sector to the next? Hopefully you get my point. This is more about explaining exactly how you go about really fixing this potential misallocation through this, reallocation of leaders. So it's more curiosity. Just tell us more. I think the reader, at least, I wanted to know a little bit more. Finally, my last comment has to do with what Rafaela was mentioning at the end, that she didn't get much time to show. And so one interesting finding that they show in the paper is that part of this mismatches or dysfunctions in the CEO market are correlated with the availability of business education opportunities, high quality business education opportunities in certain regions. And so this builds towards my last comment, which is discussing causes. And I really like the idea of thinking about the importance of business schools. I, after all, work in a business school, so I would like to think that we're important. But I also think that labor is the main endowment of most individuals. And if you think about middle-income countries, I think what that means is that a very important source for learning how to be a manager is learning from where you work. So I would like to see a little bit more in terms of opportunities for learning to be a leader outside of the classroom. And we have good evidence from research that if you work at a larger firm, at a more productive firm, or at firms that have, for example, better management practices, going back to Rafaela's own work, you could potentially imagine that people will learn exactly the traits that you need to be a leader. And so the data that I'm showing you here comes from my own work, where I've been looking a little bit at this question using LinkedIn data. And in the plot to the left, and this is just as a motivation, what I have here is I've divided firms by age buckets. So the ones in blue are going to be the very young ones, and the ones in less than 10 years old, and the ones in green are going to be the older firms. And what I'm doing here is for every year that I can see new appointments of managers, I'm basically asking which fraction of these individuals have an MBA or formal business background. And then as you can see, what we see over time is a decrease in the importance of this formal business education. Of course, this is just motivational. This is not to say that MBAs don't matter. But in the plot to the right, what you can see is, again, from my own work, if you focus on the very young firms and you focus on one particular source of potential learning outside of the classroom, which is having the startup that you work on participate, for example, in a business accelerator program or in a government support program that is tried in this business, what you observe is that newly appointed managers are now coming from these types of firms, the ones that have been exposed to these programs, at a rate that is comparable to the individuals that have some sort of formal business training. So anyway, my last comment was that, thinking about sources of learning outside of the classroom, but it's a great paper. I encourage everyone to read it. Thank you very much.
So now we have 10 minutes for discussion. I think if you want to take like a couple of minutes to maybe answer.
I just want to thank you because that was great. Thank you. Very positive first, and second also very constructive. Really appreciate it. Yeah.
Welcome. So now we open to the floor. We have a couple of here in the front. And then I come.
So I just wanted to say there's complementary evidence, so which I think you might find interesting, and that is I have a paper with Cam Harvey and John Graham in the JFE, which looks at which asks the question: what are the behavioral traits of CEOs? Does it differ from others in the teams like CFOs? And does it differ between the US and non-US? So we actually measure risk aversion by giving gambles in the Barty et al. Kind of thing. Yeah. We measure optimism the way the psychologist does by giving a LOTAR test. And what we find is the short results, CEOs are much more optimistic and risk-loving than CFOs, which may not surprise you. And if you compare US versus non-US CEOs, US CEOs, again, they are much more risk-loving, they are much more optimistic.
And so Franklin Allen has, this paper where he says, why do you find all these differences across countries and, the objective function that seems to be pursued by firms? And one reason could be that their traits are just different. So anyway, completely different measures, but I think it's complementary.
I love your
it
paper.
Supports
totally.
what you have.
I have seen and cited your paper, yes. Very consistent.
Yeah, so perhaps related. So if I think of a CEO or a leader, I think about the ability to innovate, perhaps the risk-loving attitude. So I didn't see these characteristics among those that you used to distinguish. So how should I think about that? And then another point is probably these characteristics like ability to innovate, risk-loving attitude are more important in some sectors than in other high-tech sectors. Do you have any evidence, or can you look into cross-sector differences, because the impact on productivity might be very different?
Very nice paper. How do you transition from being a firm that needs a manager to being a firm that needs a leader? Right? If firms that need a leader tends to be the bigger, publicly traded, and so on, maybe I need a leader before I become such a big firm. So in that case, mismatch may not be a bad thing.
Julian, you want to?
I'm just curious what fraction of the managers are founders were their family members, and how does the productivity loss here compare with the productivity loss of having too many family firms in many developing countries?
Yeah. Should I answer?
Yeah, maybe, yeah.
Okay, so I'll start from the last one. Actually, this is a very important variable for us, and I think it speaks to the selection of the leader. So one of the things that we're exploring is that as a source of friction. So absolutely well taken. On your question, this is all cross-sectional data, and so I cannot measure the evolution of the match of the company from one stage to another. But intuitively, I think it has to do with the complexity of the operations of the firm, and so that's why firm size is so important. And going back to your point of innovation, we don't measure it directly, but it's everything that has to do with going from something that you can monitor or to, for example, product innovation or process innovation. I think that these are typically activities, and I'm speaking more from the perspective of qualitative evidence than quantitative evidence, but these are activities where the role of the leader is not so much to do himself or herself, but is to enable the work of others. So I think that it's at that stage that this ability to corral expertise and motivate people who have different capabilities becomes very important. And then I already told that I really love your paper. Okay.
So can we come here?
Thanks a lot. I recall a paper of Daron and the co-authors that pointed to the fact that when firms, I think it was on Danish data, when firms had the MBA CEOs, unfortunately, one of the outcomes was actually cutting the workforce, and this is what made them more profitable.
The wage bill.
Apparently,
yeah.
Yes, which was maybe not the first attribute you would want to have for an MBA, but apparently there was a kind of bias for students who had been educated in business school, myself being in a business school. So, but it was Danish data. So, but
yeah, the Danish MBAs are terrible.
Look, but so just to caution maybe about your policy recommendation of
to increase MBAs. No, to be honest, look, I mean, it's a great paper. I'm not sure that I fully agree with all the results or that the results make me feel good. But I think the more general point, and this relates to your comment, is that I think that managerial capabilities are not something that appear just because you're the firstborn son. I think that the more general point is that you need to nurture them or you need to recognize them, and the MBA piece is a very rough proxy of at least selection into learning some of these skills, which I think become very important. I mean, I'm not really worrying so much about the US situation. I'm more worried about situations where you have firms that are often quite large, and there are lots of resources, workers and capital that are concentrated in these firms, and it's unclear whether they do have the capabilities or the willingness to acquire these capabilities. Yeah.
So I think more or less, so we have like 20 seconds to, so we are moving from like top CEOs to top firms, superstar firms. Joran Ma from University of Chicago booth will present, and then we have Marta Morazzoni from University College London discussing.
Thank you very much for having me. This is joint work with Ben Puxley, who's an expert on firm dynamics, Hamin Chin, who is an expert on computation, and Casper Zimmerman, who's an expert on history. So next year, 2026, is the 250th anniversary of the Wealth of Nations. And people at Chicago have a habit of trying to think about how is our world different from the world of Adam Smith. And if you go back to this founding document of economics, Smith envisioned a world that is filled with small producers. It's completely decentralized, kind of atomistic capitalism. And today when we wake up, at least our world is very different along one dimension, which is this is a world dominated by giant companies that have tremendous influence on economic activities. For example, in the US nowadays, the largest 1,000 companies by sales, if you add up their sales, it's about 50% of US gross output. So then given their tremendous influence on economic activities, it's natural to be curious about where these largest firms come from, what are their life stories, what are the patterns of their formation, and is their dominance persistent? Interestingly, our understanding along this dimension is still fairly limited. In many of the firm dynamic models that we work with, we have a very simplified framework where firms face idiosyncratic shocks, and the largest ones are just the lucky ones that accumulate good idiosyncratic shocks. And firm age distribution is stationary. The top firms are displaced all the time. Whether that's true in the data or what are the patterns in the data, we actually don't know that much about what has been happening. Sometimes people infer from the profile of large firms something that might be happening in the economy. I'm personally a huge fan of the Draghi report on European competitiveness. Maybe some of you contributed to this work or wrote the quote that I'm using. But do we know if this is true? Should we look at the age profile of large firms to infer something about what is happening in the economy? So in this paper, we collect new data to understand the life stories of the largest US companies throughout the past century and how they've evolved and the ebbs and flows of the top companies and the stories and mechanisms behind them. We also then supplement this with some European data that you'll see later. And we find the following empirical facts. First, if you look at sectors like industrials, which is predominantly manufacturing with a little bit of mining, it turns out that the emergence of the largest firms is super uneven over time. It's not that we get prospective superstars born every year, every decade. It turns out that if you look at today's largest US manufacturers, they were born at the turn of the 20th century. If you look at the largest US manufacturers 50 years ago, 100 years ago, they were all from that generation, the generation that was born around the turn of the 20th century. So that generation has been very influential for more than a century, and we call that the special generation. And at the same time, the individual top companies actually have changed quite a bit. I will show the details later. That's not always and universally true. In a sector like retail and wholesale, it turns out that there's no special generation. The top firms emerge all the time, and age distribution looks fairly stationary. And today and in the past, the largest retailers and wholesalers are roughly always about 60 years old. Now, services, there were very few large services companies before 70s and 80s. Today, there are more, and they look quite young. They look actually very much like the largest industrials at the beginning of the 20th century. Whether there will be a special generation, it's too early to tell. We will have to look back on this 50 years later. So overall, when you put together the collection of evidence we see in the US, it turns out that there are some settings that produce top firms, where especially generations of top firms that end up being dominant for decades to come. And so then going back to the Draghi report, it's true if Europe wants to have top companies in the domain of services, it could very well be that if you miss the boat now, then you'll miss the boat almost forever. We'll come back to this. But then why is that the case? Why do we see such persistent special generation, especially in manufacturing and potentially in services, not so much in retail wholesale? We will do extensive investigation of firm dynamics models later on to understand the driving forces. Long story short, to our best understanding, this type of special generation is very likely the symptom of firm dynamics in the aftermath of industrial revolutions. So now if we have an industrial revolution in the services sector, maybe we will repeat that story, but we'll have to see. So the foundation of this work is pretty extensive data collection on the identities of the largest American companies over time. Nowadays, you can go to Fortune magazine and get such lists. Back in the days, we used Fortune magazines going back to 1955, and then before that, there was a snapshot of the largest American companies in 1917 compiled by historians. And once we have these lists, we then go on to research the origins of these companies. Today, if you go on the Fortune 500 and so on company websites, you easily find their own narrative of their story. They were founded in year X to do Y. So that's reasonably straightforward and definitive. Earlier on, especially for the largest firms in early 20th century, we need to go through business history sources. We've done a lot of due diligence to make sure that these our dating is accurate. You can cross-check with sporadic dating that others have done. Unfortunately, in US Census data, for example, they don't know the firm age for those founded before 1976. But if you look at very broad age groups, what we find and the broad course picture in census align pretty well. Happy to talk about the details if you're interested. And we're also very happy to share the data. So what do we see? Standing from today, if you look at today's Fortune 1000 companies, and as I said, these companies account for half of US gross output, so they're tremendously important. There are some sectors that are not so represented among top firms, and we don't pay too much attention to them, like construction. And then there are some sectors that are so regulated, it's too complex, like utilities, so they're not the focus. In industrials, which is predominantly manufacturing plus a little bit mining, you see the largest cohort among top US industrial firms are those from the 1900s. So my x-axis is the founding decade of the firms, and the y-axis is how many of firms were founded in each decade. So industrial has this big hump around the turn of the 20th century. Services, the hump is around 1970s and 1980s. Trade, which is retail wholesale, the hump is around 1970s and 80s as well. So we first dig deeper into industrials. People have, if you look around at the largest US manufacturers like Pfizer and Boeing and so on, yes, they are old, but they used to be young. So if you look at the largest US manufacturers in 1955 and do the same exercise, it turns out that, again, 50 years ago, the largest US manufacturers were also those from the turn of the 20th century. And if you lived in 1955 and tried to imagine the world, and if you adopt the stationary conjecture, then you would imagine that by now, the birth year distribution of large firms is going to be the dashed line. You just move forward by 60 years. But in the end, we don't. The birth year distribution looks much more similar in calendar time than in terms of stationary age distribution. And even more strikingly, if you look at the largest US manufacturers in 1917, they were still the generation from the turn of the 20th century, which means at the time they were exceptionally young. So their average age at that time was about 30 years old, became 60 years old in mid-20th century, and now about 100 years old. There's the aging of the top firms. But they're not the same companies. This is one way to try to convey to you how the individual companies have changed. So the dark blue line is still the birth year distribution of the largest industrials now, and then the lighter blue lines are the subset of them that were also the largest in 1955, which is about 30%. And then the gap means what we call late bloomers, firms that were not the largest in 1955 but are the largest now, yet they're still old, like Pepsi, Clorox. You can actually name quite a few of them, which had fortunes turned in favor of them later on. And then you can also name many of them that used to be large and then disappeared, for example, Swift and Armour and Borden and so on and so forth. We give many such examples, which is true not just for manufacturing as a whole, but also for subsegments of manufacturing. Now, when you look at other countries, we have less data, but some data from Germany and the UK. Long story short, Germany is actually very much like the US in this domain, that the largest German firms or systematically those from the turn of the 20th century. UK actually not so much. UK's large manufacturers have relatively stationary firm age distribution. There's no generation that persisted. Why? Well, Chandler, a very famous economic historian from Harvard Business School, speculated when he was writing in the 1990s that the German firms during the Second Industrial Revolution took advantage of new technologies, built lasting enterprises, and UK firms were lagging behind. They were insisted on family management and so on and so forth. We'll come back to this investigation in a few slides. Now, outside of manufacturing, in retail wholesale, as I said, firm age distribution is actually stationary. You used to have the department stores, and then the drug stores, and then the discount retailers. So the generations actually move on instead of in manufacturing where some generations stay. So that's the data in a snapshot. And services we don't know, we see some resemblance of the largest manufacturers in the early 20th century, and we will wait to see if they form a special generation going forward. So why might this be the case? And also that will inform our understanding of what might happen to services, and also is Draghi right to say that Europe is in some trouble for not having young, large firms in the services sector. We start with benchmark firm dynamics models just to fix ideas, and we embellish it with more elements to see what can generate, for example, special generation. Some of you are probably very familiar with the Hoppenheim models. Some people may not work in this space, but the idea is very simple. You have firms that have productivity. One element of productivity is permanent, which is in red, and then there are shocks to productivity. And if you start with this simple type of firm dynamics model, you will get that the overall age distribution is going to be skewed towards young firms, not surprisingly. Among the largest ones, you will get a hump, which is the natural hump that the young firms haven't had enough time to grow, and the old firms have more time to die. So you will have middle-aged firms most represented among the large ones. That also means you can't just look at firm age distribution at a given point in time and say if it's special or not. The reason that we can say definitively special generation exists in manufacturing is because we can see them through many different cross-sections over time. So then how do we depart from this stationary world and embed elements that can generate special generation? We've done explorations along 3 dimensions. These are the 3 most common conjectures. If you have further conjectures, we're happy to consider and work on them as well. So the first narrative, again, I will attribute to Chandler, is this view of the long aftermath of Industrial Revolution. During the Second Industrial Revolution, scalable technology came around, And especially entrants were well positioned to adopt them because the incumbents were rigid and they fell behind. So entrants adopted these technologies with some very mild degree of first mover advantage. This cohort can actually persist for quite some time. The second hypothesis, which is also very common, is that manufacturing maybe was growing very rapidly in the early 20th century and then it declined, so there are fewer entrants now than before, and the large number of entrants maybe from the early 20th century was the reason for the special generation. We also pay tribute to that hypothesis. The third one is maybe regulation has somehow shifted that made entry harder. Later on, we will investigate that as well. So for the Chandlerian hypothesis, the main modification that we do is to make production technology heterogeneous. Instead of having only the traditional production technology, which is what you see without the K term, we say there's another modern production technology that's more scalable, that has the K term. And firms, when they enter, they choose the production technology to operate with, except that this modern technology has an adoption cost, so you don't get it for free. The traditional one, you can just use it for free, modulo the fixed entry cost for everybody. And then we have a reduced form representation of first mover advantages, which is learning by doing, which is productivity grows with age, you build organizational capital, et cetera. So in this very simple world, we do an experimentation where during the second industrial revolution, the adoption cost of the modern technology declines over time. And we see what happens if this occurs. And we date the second industrial revolution following, for example, Gordon, which is 1860 to 1900. And so there's a pretty elaborate calibration. It's not an easy calibration because we're dealing with a moving target. The firm size distribution, the firm age distribution is not stationary yet. Everything is moving, and you can see the paper for more details of how we address that. After overcoming these computational hurdles, we can show that if we match a combination of moments that govern the more usual firm dynamics, like entry rate, exit rates in normal times, together with the age of top firms over time, the fraction of them that come from the early 1900s, we can actually have a model that matches moments very well and also produce these patterns that are not targeted. And these patterns are the age distribution of top firms in manufacturing over time, as well as how much of the top firms today were also top firms in the 1950s. So Chandler does pretty well in matching these facts. The other two hypotheses, less so. Well, there's some elaboration about how Chandler succeeds, which I will skip a little bit in the interest of time. The combination of the new technology, which differentiates this cohort from firms that came in before, and learning, or very mild first mover advantage, which differentiates from potential entrants after, that combination turns out to work well. For the hypothesis that manufacturing was growing in the past and then it started to decline, this actually is not so easy to match the data, in part because if you look at US manufacturing growth, there's nothing super different from 1880 to like 1920, which is the decades of our special generation. Manufacturing growth was pretty high until 1960s in the US. So if we have to live with that and maintain the fact that manufacturing was growing quickly for a century, then it's just very hard to generate patterns that you see in the data, which is very concentrated birth of these prospective superstars within the window of roughly only 40 years. It turns out if you respect the fact that manufacturing has been growing quickly until the 1960s, then today you would expect the most represented cohort among large firms are the ones immediately before the end of high manufacturing growth. Now, finally, we also investigate things like time-varying entry costs. What is this? Well, this is a response to the conjecture that maybe US regulation has changed somehow, entry became more difficult. By and large, the challenge with this hypothesis is if you just think that regulation has become more difficult, entry has become more difficult, it doesn't explain the emergence of the special generation, why they suddenly emerged in the 1880s, what differentiated them from the firms that came before, and you need like pretty elaborate tricks to push that generation onto the scene, and then that messes up many other things that I won't have time to elaborate. So that's the story of industrials, at least to our best understanding. What we see is long echoes of the second industrial revolution, which may then transport to services if services also have the feature of these new technologies coming into the scene, and even very mild first mover advantage is going to do it. I forgot to mention that this story can also match the fact that the top firms, the individual top firms, change all the time. That's just the magic of idiosyncratic productivity shocks. If you use idiosyncratic productivity shocks that match census moments and so on and so forth, it turns out that they're actually enough to produce quite a bit of shuffling among the top firms, even as the generation persists. So then finally, what's different in retail and wholesale? Why don't they have special generation? It could be lack of technological revolution. It could be lack of any first mover advantage. So we did some diligence to see what might be going on. Technological revolution is very difficult to directly prove or disprove, but we can see in the data that it seems first mover advantage, where any intrinsic buildup of organizational capital seems fairly weak in retail. It could be, Ben likes to say retail is an open book. You can see how other retailers operate. You can copy and imitate much more easily. And the reason that we say that is if you have non-zero accumulation of organizational capital, then the largest retailers would be too old compared to the data. If you also want to match all the other moments about entry-exit rates and the entrance size distribution and so on and so forth in retail and wholesale, we already see that the entrant size distribution in retail wholesale is skewed enough that without any accumulation of organizational capital, we would expect the top firms to be about 60 years old, which is what we see in the data. If you then give them even a very mild amount of accumulation of organizational capital, then the top firms just don't die out enough, and they will be too old. So that's our current best understanding of how these different sectors fit together. So there are sector-specific characteristics that also matter how you interpret the landscape of the top firms. So overall, through pretty extensive data collection and extensive investigation of the stories behind them, we see that in some settings, you have these special cohorts which have advantages relative to firms that came before and relative to firms that come after. If for potential entrepreneurs like our MBA students, they have to face the reality that it's not that always equally easy to build one of the giant enterprises that will last. And there are special opportunities, times of major industrial revolution, of technological disruption that are particularly conducive to the emergence of these top firms. Will such a special generation occurred in services? The conditions, based on our understanding of the model, is the combination of new technologies that expand returns to scale, which is likely in services, and adoption particularly conducive to entrance, which may also be likely in services. The services have new business models in many ways, and very, very mild organizational capital accumulation is enough. And the combination of these factors is going to produce hysteresis. So then if I were to speculate Draghi's diagnosis of the fact that Europe doesn't have young top services firms, if they still don't emerge for the next 20 years or 30 years, it could very well be that it's just going to be very difficult to penetrate once this wave of industrial revolution passes. And whether Europe wants to have those large firms or not. If you do, then now is the time, and you need to think about how they might emerge and what are the things that will facilitate their growth and emergence. And it can happen very quickly. It can happen with a span of 20, 30 years, like what we saw in early 20th century of the largest US manufacturers that came into the scene within a span of 20, 30 years. And I look forward also to learning more from the panel, but before that, I look forward to learning more from my discussant. Thank you very much.
So now we have Marta Murazzoni from UCL. You have 10 minutes.
Yes. Thanks a lot. So first of all, I want to thank the organizers for putting together such an amazing program and inviting me to discuss an amazing paper by Weran and her co-authors. So this is a paper about superstar firms through the generations. So of course, a very timely topic, and as already said, very policy relevant. So just a summary of the paper, the way I perceived it, the way I read it. The research question or questions that this paper tries and succeeds in answering is whether there are some generations of firms that are actually special, and what can give rise to such special generations of firms. The paper tackles these research questions in two ways. One is more like empirical, and then there's a very carefully crafted model and quantitative framework. So on the empirical side, they go above and beyond what I thought it was possible in terms of documenting in the data that top manufacturing firms in the 1910s, in the 1950s, and even today, predominantly date back to some decades at the beginning of the last century, end of the 19th century. And this special generation is indeed staying over time, even if turnover among top firms is substantial. And then they also document how the experience of industrial firm might be compared and might be different from firms in sectors such as services and trade. The quantitative framework brings about a novel model of firm dynamics in which adoption of a scalable technology and first mover advantage through learning by doing can indeed rationalize the experience of industrials firms at the beginning of the last century and why they are still relevant nowadays. So the key results are also that time-varying market size growth rates, so an alternative explanation for this advantage, this special generation or entry cost could not produce this special generation that we do see in the data. Among retailers and wholesalers, learning seems to be weak, so this process of learning by doing might not be present, and perhaps this is why a special generation is harder to sustain and then quite standard in the literature of firm dynamics. Idiosyncratic productivity shocks can still explain much of the turnover that we do see in the data. So the point of the paper in just one sentence is that lasting non-stationarity among top firms can stem from sudden waves of technological change. So I have comments, or rather questions rather than comments, because the paper is done, the paper is finished, and so carefully crafted. So perhaps these are my questions for future papers by Weran and her co-authors. So I do see why the firm distribution clearly is non-stationary in manufacturing among industrial firms. But if one looks at the number of firms for services, there seems indeed to be a special cohort born in 1950s and through 1980s. Even looking at employment or sales in terms of metrics, we do see that even for trade, there seems to be a special cohort. And I do find interesting, they document in the paper that 50% of retailers and wholesalers indeed persist from 1955 to 2018. It's true that the resulting firm distribution doesn't seem to deviate so much from non-stationarity, but I have maybe a question of whether maybe a next census or a next fortune list could actually find evidence of non-stationarity there. So there is a clear cohort effect, But perhaps throughout the board in different sectors, we can also see instances of declining business dynamism. And yes, the paper documents turnover is present even for top industrials, yet once domestic or foreign acquisitions are accounted for, I was surprised to see that 60% of firms persist from one list to the next one. So I think that this, of course, diverts a bit from the current scope of the paper, but maybe for a future paper it would be interesting to connect multiple literatures, investigate non-stationarity perhaps arising in other sectors. And what I mean by multiple literatures is perhaps looking at this decline in business dynamism, this increase in mergers and acquisitions, and how this could further contribute to slower dynamism in the economy. A small digression that I found quite interesting is why there was no special generation of industrials in the UK, but yes, in Germany. I understand that through the lens of this model, it's because they could not adopt technology or they could not learn as much. I was also perhaps thinking that there could be further explanations that could differentiate the experience of the UK, US, and Germany, and these come from my comments on the quantitative framework. So the questions that I have on the model and the quantitative exercise, first of all, from a very perhaps boring point of view, I think it could be interesting to maybe explore further the role of ex-ante firm heterogeneity. So you said we're looking forward to other type of explanations that we could test, and maybe this is one that I was thinking when reading the paper, because what distinguishes firms at start in your model is their own fixed effect, let's say, and the initial draw of this time-varying productivity. So my question was, could a temporary change of these two produce a special generation, and how could we interpret the special generation of industrials through a temporary change of these two? So my question is, perhaps would a high draw of permanent fixed effect be akin or make the adoption of a scalable technology easier for a generation? Would a high draw of initial productivity plus a properly calibrated productivity process be akin to learning? These were questions that I was having when reading the paper. And then perhaps going more into let's say, future papers, perhaps it could be interesting to explore the potential role of increasing returns to scale over time. So there's a growing literature in firm dynamics, in macro, in IO, documenting rising returns to scale. And so again, my question is, could higher fixed costs or higher returns to scale explain the aging of industrials despite their turnover? And this is just a boring comment on the details of the calibration. So just concluding, overall, I think this is a very timely paper. It's an incredible research effort, really at the frontier. And the paper is ready for the submission. There was very little that I could comment. Thoughts for the, again, future projects, perhaps. This paper shows that incumbents pre-second industrial revolution could not adopt as easily the new technology. And the learning also motivates why this cohort of entrants at the turn of the last century was so successful. My question is this the last big technological innovation wave? And you seem to suggest that specifically in other sectors, we might be observing a new technological wave. And so how can we, for instance, in Europe, take advantage of that? Did successive incumbents compared to the second industrial revolution become good at incorporating technologies or at learning? So didn't we see a new generation, for instance, in industrials emerging because the shocks ever after were not as big, or was it because incumbents as well became more able to incorporate new technologies and learning? And in times of slower growth and slower business dynamism, what's in for policy? You addressed already this question in the last couple of minutes of your presentation, and I think it's very interesting. So perhaps a future paper would be trying to use this quantitative framework to understand what's in there for policy for this continent as well as for the US. Thanks a lot.
Thank you, Marta. Maybe you take a couple of minutes and then we open up.
Just one thing. Thank you so much. It's super helpful. I just want to comment a little bit on declining dynamism, which I imagine many people are interested in and might have wanted to ask. So it didn't make into this draft, but if you actually, because we already had a lot of material, but if you compare, for example, largest firms in 1955 and then take now, and then take a midpoint, like say 1985 and 1990, actually the turnover among top firms is greater between 1990 and now than between 1955 to 1990. Wow. So the dynamism at the top doesn't seem to decline. And then there are McKinsey quotes that say, oh, S&P 500 firms used to be there for like many decades, and now they're only there on average 15 years, something like that, which is very difficult to substantiate. But it's actually true that top firm dynamics didn't decline over time, as far as we can tell. I think there are probably different drivers of the dynamism at the top than general dynamism in the economy, which is also interesting and has been studied extensively. At the top, as you said, what are the technologies that require incumbents versus entrants to implement, and so on and so forth. That's what I'm working on now. Acquisition, that's a smaller point. A lot of the acquisitions happened when the target was failing, like Union Carbon and Carbide, Republic Steel, and so on and so forth. So it's a little bit tricky to say if you survived through your acquire, actually, whether you are still dominant. And many of them were almost disasters. That's it. Happy to take questions from the audience.
Questions? So let me, yes.
Hello, it's Paola Di Casola from the ECB. Thanks a lot for the presentation and discussion. It's very interesting. I was wondering if you had thought about the issue with the financing, so the differences between the industrial sector and these differences you find with the retailers, whether it's about the type of financing that these firms have to need and the way they need to set up their connection with the banks or other investors. They make the incumbents having hard time and being successful in one sector or related to the other one.
Do we collect more? That's, yes.
Hi, very nice paper and discussion. I guess I'm wondering how you think about whether this scalable technology can actually come up from the special generation as one of the outputs that creates these companies, that are so special and that turns out to be scalable, that could have an impact on the dynamism at the top that you were referring, because in a way of like self-fulfilling, this firm is developing a scalable technology that's going to allow them to be special and grow and survive longer.
Okay, Rafaela, you want
two comments, one measurement and one conceptual. From the measurement side, I see that it's interesting to do in the industry, services, and wholesale retail. But one aspect of US firms in particular is the fact that they've grown tremendously across boundaries of manufacturing. And so Teresa Ford has these beautiful papers using the census showing this bleeding into services of manufacturing. So I'm wondering whether maybe that classification may be misleading, because one of the things that characterizes these firms is exactly how far they go in terms of scope. And conceptually, the lack of learning, could that be that actually the technologies are evolving so quickly that it's hard for any one company to capitalize on one vintage of technology, just because there are, in those sectors where you don't find evidence of learning by being dominating, maybe it's the cycle of technological change that is faster.
Okay, great. So for the financing question, that's very interesting based on, it's not easy to find concrete data on this, but it seems that in general, manufacturing has depended more on external financing than services, even though early on, like Rockefeller's time, they were mostly doing internal financing. Now they rely more on external financing, but like retail wholesale is still more dependent on internal financing. But I think that's more of an outcome of the underlying technological feature that in manufacturing you have much more scalability. That's why they needed external financing. Happy to think more about this, but at least on the spot, I don't think there are intrinsic reasons for access to financing to differ across these industries, especially in a country like the US. But there are reasons that they ended up using financing differently because of technological features. For whether it's self-fulfilling, you reminded me of John Sutton's indulgence and cost type of arguments. We have a lot of representation from LSE London. It could be, but I think, maybe it's a bit speculative, some of the technology is to a large extent exogenous. We are taking it as exogenous. But yes, people develop technologies for a reason, but then technologies at some point, like AI, we pursue that for a reason, but then at some point, because of luck and so on and so forth, there are breakthroughs, and then they have implications for firm dynamics, for who is best at implementing them. For the question about industry composition, we did very elaborate coding of the industry at the beginning and the industry now. Actually quite surprising to me, if you take their current industry code and compare with the industry that best described their business at the beginning, which is much easier because they were doing one thing at the beginning. The overlap is 80 to 90%. So the current industry code, I mean, just from CompuStat or SEC registration, the industry that describes their main business, which is the one most represented by sales. So migration actually along some dimension happens, but to completely different field actually is very rare. And in fact, you actually see this also in the decline of companies like American Can, Continental Can. When they were declining, they tried to do other things like financial services. It was a disaster. American Express is, I think, the most extreme outlier of going from express mail to financial services, but those are extremely rare. So Teresa Ford's paper, if I remember correctly, was saying that manufacturing firms do more and more services. Right? And we are being conservative. Actually, I think IBM and Intel and so on are still being classified as manufacturing. And despite that, the special generation from early 20th century in manufacturing survives, even though Apple might even be in the data set, be classified as manufacturing just because of their SEC registration. So it's despite of that.
Or maybe because of that, right?
Well, if they were classified, so these younger manufacturers like NVIDIA or Apple, they're still tagged as manufacturing instead of services. And despite these few recent successes that are straddled between manufacturing and services, the entire manufacturing landscape is still dominated by the old firms. But they will be washed out at one point, according to our model, in 500 years for sure. It will disappear.
So thank you very much. Fantastic. I would like to thank you, all, for presenting and discussing. Please, super big round of applause. And we are now moving to the coffee break. So we are back at 4 for the policy panel. We're all also very excited about that. So 30-minute break, more or less, a bit less, and we're back. Thank you. Thank you so much.
Welcome back to everyone in the room and to those watching it on Bloomberg or on the live stream. I'm Stephanie Flanders, Head of Government and Economics at Bloomberg. That means there's a team of economists working under me, but also all the economic and political reporters. So I'm constantly thinking about both the theory of what's wrong with the European economy and the practice of how we might put it right. And the title of this session, where we have this fantastically accomplished panel, you will see, is How to Revive the European Economy and Unlock Its Potential. And I was thinking about this before the session, thinking there are many areas in which Europe's economy we should worry about and it had fallen behind. But one area that we surely excel in is in the study and comprehension of what's wrong with the European economy. I can't think of any other region in the world that comes close to Europe in the rigor and detail with which researchers and policymakers have analysed exactly what the problems are with the Eurozone economy. In fact, our own economists calculated last year that if the Euro area economy had just grown had kept up with the US since the beginning of the Euro, the region's economy would now be 18% larger, 3 trillion euros larger. And of course, that would have implications for many of the discussions we have today, because not only would average income per worker be around 13,000 a year, 13,000 euros a year higher, but there would also be more tax revenues, potentially more space for governments to devote to key challenges like defence that we're now talking about. I think we've also been pretty good at identifying solutions to these shortcomings, and indeed we saw Mario Draghi deliver his report last year. There were several hundred, 383 individual recommendations in that report. But of course, as we all know, the real issue has been in implementation of any of this. And there it's only been, I think it was calculated, 11% of those recommendations have been fully implemented, and around 2/3 have really seen no progress at all. So I'm delighted that we have seasoned policymakers and economists on this panel who not only have the keen understanding of what's wrong, but also from their practical experience working with policymakers and supporting good policies on the ground in their various capacities at various times. I'm sure they're going to be relentlessly practical and realistic in thinking about how to revive the Eurozone economy. And I get the impression even optimistic, which would be a nice change. We have Isabel Schnabel, who has been a member of the executive board of the ECB, obviously since 2020. She had a career as an academic economist and a banker before that. Andrea Mechler, Deputy General Manager of the Bank for International Settlements, who had previously been at the SNB and IMF, of course. And Beata Jaworczyk, who is the Chief Economist of the European Bank for the EBRD, European Bank for Reconstruction and Development, and a professor of economics at Oxford University. So thank you to all three of you. We're going to hear up to 10 minutes from each of them on the topic. Then we'll have a discussion and we'll also bring in the audience. So thanks very much. And Isabel, over to you.
Good afternoon. Thank you, Stephanie, for the introduction. And it's such a pleasure to be part of this fantastic panel. And as Stephanie said, we want to be optimistic this afternoon. We want to be solution-oriented. So let me start by saying, and I'm sure everybody in this room and online is going to agree with that statement, Europe is a great continent. And it has a lot to offer. It offers a high quality of life, a high level of social security, a strong democracy with strong institutions protecting the rule of law. But all of this doesn't come for free. And to be able to maintain these achievements and to tackle the new challenges like climate change and the security threats, we need economic growth. But, and you've seen these kind of charts many times, Europe has fallen behind on productivity growth. And this is not a recent phenomenon, but this has been going on for a long time, over several decades. And one reason for that is that Europe has missed the digital revolution. And this is not just true with regard to innovation, it is also true with regard to adoption and diffusion of technologies. And European competitiveness is under threat because China has moved up the value chain. Some people call this the second China shock. And it has now become a main competitor in advanced technologies. So many of the technologies where Europe used to be very strong in. I mean, electrical vehicles is only one example, but it's much more than that. And as you can see on the left-hand side chart, the euro area has been losing export market shares, again, over quite some time. It didn't start with the recent trade war, but it started well before that. And of course, in turn, China's export market shares have soared. One issue that is displayed on the right-hand side is relatively high energy prices. And already before the pandemic, the energy prices in Europe were relatively high in comparison with areas like the United States. But of course, that was reinforced after the Russian invasion of Ukraine. And we all know that energy will be key for future technological advancements. So this is an area of concern. So what is needed? I would argue that the revival of euro area growth relies on three interconnected pillars. The first is integration, the second is innovation, and the third is sovereignty. Of course, none of this, as Stephanie said, is new. Many of us have talked about it for a long time, so, but sometimes it's good to say things again and again in the hope that people will finally act. So the first is integration. And we have this wonderful thing called the single market, which offers huge, unexploited potential. And this is still true for the trade in goods, but it's especially true for the trade in services. And even though some progress has been made recently in financial integration, of course also there is scope for more. So why is integration so important? As you can see in the chart on the left-hand side, euro area firms are very small on average. But we know, and the right-hand chart shows a study on Italy, we know that scaling up would have a significant positive impact on productivity growth. But all the bureaucratic and regulatory hurdles make scaling up across member states very challenging. Of course, what is needed is a certain degree of harmonization. But harmonization is a tedious and very time-consuming process. So I believe that a true game changer for integration and innovation in the EU would be the introduction of what many people call the 28th regime. So what is that? The idea is that you create a new EU-wide legal form for businesses that allows the firms to easily scale up across the entire European Union. Of course, this kind of 28th regime must comprise things like corporate law, insolvency law, tax law, labor law, and all of that are, of course, contentious areas. It could be wise to focus specifically on innovative companies, on startups, but importantly also scale-ups, because this is where the real issue lies.
And by reducing the regulatory and administrative burdens, by increasing mobility of labor and capital, and by providing higher legal certainty, we would achieve a greater scalability of firms, and this in turn would lead to higher productivity and also more innovation, because the access to the large EU market would make it more profitable for firms to innovate. So for me, this is one of the key proposals that was in the Letter report, that is in the Draghi report, but what we need now is concrete proposals on how this can be done. So that was in integration. Innovation obviously is essential for potential growth, and again, Europe has fallen behind. If you look at the number of patents, interestingly, not in all areas. One area where we're still pretty good is green technologies. So green technologies can be an important source of innovation in Europe, and we should keep our strong focus on this area. Of course, innovation requires capital, not any type of capital, but risk capital. But it's not just about the funding. It's about, when you talk about like venture capital and risk capital for innovative companies, it's also about expertise, not just money. And what you need is you need to build entire ecosystems for founders where you get the money, but you also get the expertise. Demography is working against us. The aging society limits production. It also limits innovation. And so we have to be very clear that we will not be able to foster growth without immigration. And we should seize the opportunity that nowadays there may be quite a few people who are interested in coming to Europe across qualifications. We're not just talking about high qualifications, we are talking about all qualifications. And this seems to me one of the key ingredients to a growth strategy in Europe. So besides integration and innovation, we need sovereignty. And defense is at the core of sovereignty. Europe must be able to defend itself. So it's absolutely needed that defense spending is increased. But it's not just about spending, it's of course also about building a European governance for defense. In addition, we also need sovereign solutions for the digital age, cloud solutions, the area of AI that I think Andrea is going to talk about later. And I stole this slide from a presentation that Beata gave at our Sintra forum not so long ago. We need to de-risk our supply chains. We have become strongly reliant on especially Chinese raw materials, and we have to see how we deal with that. We also have to de-risk our payment systems, where we are very strongly dependent on US payment providers, and the digital euro is one way to deal with that. And of course, for sovereignty, we also need a strong currency. And this is our responsibility here at the ECB. This is why we think it's so important to foster the international role of the euro. But as President Lagarde said in a recent speech, this role needs to be earned. It doesn't just fall from the sky. In all of what I talked about before, everything related to innovation, growth, integration, defense, and so on, all of that is also the basis for a strong euro in the international sphere. And of course, the international role of the euro would also be supported by a large and liquid European bond market. And we've made some important steps in that direction, but more will be needed. So summing up, we need integration, innovation, and sovereignty to maintain and strengthen Europe's place in the world and to protect our past achievements. Thank you very much.
Thank you very much. It's a great pleasure for me to be here. And it is to reflect about the challenges of Europe, but not just the challenges, but it's also to try to reflect on how do we transform challenges into opportunities. But I do want to say this today, the conference is also about spotting talent. And I want to thank the organizers for at lunch all the poster session that we've seen of all the, if I can call you like this, the upcoming talents. It was just absolutely amazing to see the depth in one poster and to have the discussion. So thank you for the organizers, and importantly, thank you for all of you who have participated in this very important and a good way of networking and getting to know all of you. So I want to turn my attention to AI. AI, we know, it has the potential to transform the way we work, to reshape the way we work and think even. But AI also comes with, and in particular now from a public authority perspective, from a central bank perspective, AI also comes with a responsibility. AI is likely to reshape the way that the financial markets work, and there is a responsibility to adopt AI in the first place, but to also ensure we can adopt a responsible, safe, and ethical AI. So how do I think about AI? AI is such a big topic, right? So I like a picture. So this is one picture I like. It's an iceberg, I know. But what do I mean by this? Because to me, AI has two sides, right? It has a visible side above the water, right? These are the things you see. These are the chat box, the analytics, the dashboard, the automation tools, all of this. The things that we use, or we should be using and adopting more. These are great, but these cannot function unless you have what is underneath the water. The things you don't necessarily see and yet are so important, right? This is, of course, all the infrastructure, the cloud, and to think about the risk around them, the cloud infrastructure, the risk and the governance. How do you make sure the models are explainable? How do you make sure you understand the data governance is a very important one. The platforms, what is it you're interacting on? And of course, very importantly, people skills and training. And unless you have this, what is happening underneath the iceberg, you will not be able to really enjoy in an effective way what I call above the water. So let me come to Europe. Where do we see, and I think Isabel mentioned a number of things, so some of the slides are very complementary. So I come from Washington, I've heard a lot, Europe, where are we? And yeah, we're a little bit behind. So here when we look about AI patents, right, there's a scope for greater AI adoption. So Europe is entering the field, but I think Isabel had also a really nice chart. In the area of AI, Europe has been moving forward, but really much, much slower than if you compare it to the US. So this is what you see. You see the red line is Europe, much fewer patents that it has issued than, say, in the US. But also, if you look at the right-hand side, the patent as a share of total patents, right? So this is what you saw. Europe may be ahead in other areas, but in the area of the digital revolution, Europe is clearly behind. So is Europe a lost cause? No. Let me show you another graph. So this is an interesting graph. This is a graph that looks at AI adoption. And what we see here is that among European firms across different countries, right, what you see here is that for some firms, so here what I do, the red line is AI adoption in the US. It's an aggregate. Whereas in Europe, we differentiate between what we call firms with a high financial development relative to low financial development. And what we see is the firms that fall into the category of high financial developments, the AI adoption is very similar to what we see in the US counterparts. So it is possible. So the question, of course, is what drives this? And one of the things is what we see, and Isabel showed it as well. Of course, there's a big sectoral difference. And this is what you see here. But what we have found is what is the driving factor if you try to explain AI adoption. Of course, there are many factors as usual, but it really is how much do firms invest in AI or in innovation more generally. And so if you superimpose this with sector, you see the sectors that are, say, very data intensive. They really are and they have to invest in that. They're much further along in the level of AI adoption than, of course, other sectors. So investment in AI, and when I mean investment in AI, right, it's in software, in data, you can really see a big difference about the ability to adopt AI. So the BIS actually did some very good work, actually some work, joint research with the EIB, highlights really the potential gains of productivity gains that you can do by harnessing AI. So what do we find? So they looked at 12,000 European firms, and they see that in the short run, AI adoption can increase firm-level labor productivity by about 4%. Right? This is a good amount. Now, the good news is, at least for now, that labor productivity increase is really driven by capital deepening. What do I mean by that? It is without replacing labor. So we're not seeing shedding labor and that's what makes you more productive. No, it is really the complementarity of having more capital that allows you to be more productive. Now, this kind of work, there are really three important insights. One of them is that these productivity gains, where do we see them? We see them in medium and large companies. And that is an issue. It's a little bit like the large financial deepening or not. It really is, there is a risk of fragmentation, right, about the large firm that can invest versus the others. And of course, the study also confirms what you showed in this graph, is that there is a very, very strong relationship between, or correlation between AI adoption and investment. And that's what it's interesting in software, in data system, of course, in infrastructure, and in workforce training. So given the importance of investment, what is also important, what you also see in the data, is the firms and the firms that end up being better at adopting AI are also the ones that are in countries that have much deeper financial markets. So again, this relationship between not just the size of the market, but the size is more a reflection of your ability to invest, of your deep pockets, and your ability to invest depends not only on the profits, but also your ability to access financial markets. So what does it mean for Europe? For Europe, it is about really looking that also the SME, the small and medium firms, jump on that train, and particularly on generative AI. It is about skills and retraining, and it is about offering financial access. What I want to finish with is, what about financial stability, right? Until now, I've talked about productivity gain and what it does. What does AI and financial stability mean? So again, for central banks, for regulators, we play two roles. We are big users, right, of technology, but we are also stewards of financial stability and of trust. So again, we have to lead by examples. We have to adopt AI, but we have to make sure that this adopter is also safe and responsible. So I'm not going to have any slides on this, but we know AI has opportunities, but also a number of risks. And the bigger one of the important one, and it's not a new one, is concentration. Right? We ultimately rely on few models, we rely on few infrastructure, and even we all work on the same data set. So there's issues about procyclicality, there's issue of market volatility, there are also issues of, which is a really bad one, right, of hallucination, like if we really get incorrect outputs and we don't have the critical thinking to really rethink them. But I do have one more graph. What I would say is that, yes, AI has risk, but what is interesting is how, for instance, financial regulators are really increasingly using AI. And this is what you see here. It might be very small. So it just shows that how many supervisors are experimenting, that's the red line, and developing or using, that's the yellow. And you see that in all the fields, where all of the authorities that use a lot of data, supervisor is one of them, the ability to automate, to use, to process, to manage the data really means a lot of efficiency gains. Now, efficiency gains doesn't mean you shouldn't be careful, and there really is, there is also a responsibility, an accountability towards not just looking at the efficiency gain, but making sure that you maintain the trust that goes with them. The other thing I want to say, where AI is really interesting, is particularly on the macro risk. Because one of the issues, as we all know, about macro risk was the buildup of systemic risk. They tend to build up over a long time, and you have very few events. That makes traditional empirical analysis very difficult. Well, AI, if there's one thing they're good at, is to finding a needle in the haystack, right? So AI is particularly good at recognizing patterns and at capturing complex interconnectedness among banks, non-banks, different markets. And these are areas we really ought to go into and use the ability to deepen our understanding of what is happening, particularly in the world where there are many shifts in the financial sector, and to be able to identify the risk. And I'll stop. Of course, these are great opportunities that we ought to harness, but there's one thing that is clear, is the human remains in the loop, right? The humans needs to stay there because ultimately the accountability of the use of AI remains with us. So yes, there's going to be a lot of, we need to harness this technology, but ultimately we need to stay there. We need to stay there on the individual level, and I think this is also where international cooperation and the kind of exchanges we need to do to move together in harnessing the risk is very important. I'll stop here. Thank you very much.
Thank you very much for the invitation. It's a pleasure to be joining this panel. May I have my slides? Great. So I'm going to contribute to the same discussion, how to revive the European growth, by making 3 points. First, what's the scale of the challenge? Second, is industrial policy the answer? And third, where will the money come from? So starting with the scale of the challenge. As the tennis ball that's squeezed from two sides on my title slide, Europe finds itself between two pressure points. On the one hand, we are being left behind the US. On the other hand, China is catching up very quickly. And you can illustrate it in many ways. We saw it in Isabel's presentation. But my favorite way of doing that is looking at the list of 2,000 companies with largest global R&D spending. And what you see there is that a third of these companies is American, a quarter is Chinese, and only a fifth is European. But what's particularly striking is the fact how things have changed over the last 2 decades. The share of American companies has gone up. The share of Chinese companies has gone up tremendously, while the share of European companies has dropped. And today it seems hard to believe that 20 years ago that list was dominated by European companies. Now, what about companies from the new EU member states? They are barely present on that list. There are only 2 of them, one from Slovenia and one from Hungary, both in pharmaceutical industry. Now, do we care about the fact that the new EU member states are not there? Yes, we do care, because over the past 30 years, these countries have experienced spectacular growth because they were catching up. But now they need to change their growth model to the one based on own innovation. And unless they get their firms on that list, it's going to be hard to do. Now, the second phase of the challenge is the fact that when you look at the new EU member states and look at the middle graph, what we have observed is a drop in investment relative to GDP around the time of the global financial crisis. And this new lower level seems to have persisted since then. So it's not only that they don't have companies on that list, they also saw a dip in investment levels. And relative to other regions, public investment is more important there than plays a greater role as a share of total investment. So investment, we need to see more investment. Now, of course, investment does not need to be domestic. It can come from abroad through FDI, but here is another challenge. US is attracting a lot of FDI, and already last year, US became a net recipient country rather than a net source country when it comes to greenfield FDI. So here you see data from FT Markets database capturing just greenfield FDI projects. So that's not the full picture, but it's still a pretty good idea. It gives you a pretty good idea about what's going on. And based on the data for the first half of this year, we see a big increase in the ratio of inward FDI to outward FDI in the US. Now that contrasts sharply with Germany, where we've been seeing a decline. The remainder of the EU is doing somewhat better, but nowhere near where the US is. So basically, we are seeing increased competition for FDI. Now, remember, we are talking about Europe being left behind the US and China catching up. How do we see China catching up? Well, over the past few years, we have seen increased similarity in the structure of exports between China and Europe, and in particularly the Eastern European EU member states. China's exports are more sophisticated than what you would expect, given its income level. So China is actually competing with high-income countries and sort of upper middle-income countries in terms of export structure. But when you look at what China demands as imports, many European countries are not actually producing or exporting the goods that China demands. So in that sense, US is competing with China, but it's also producing goods that China is importing. And that's to a much lesser extent the case in the EU. Okay, so is industrial policy the answer? Well, over the last few years, we have seen a big shift in the perception of industrial policy. Right? In the 1990s, industrial policy was discredited. Now it is perceived as the best thing since sliced bread. Can industrial policy be an answer? Yes, if we do it well. Right? So everybody is doing industrial policy, but most places we are not doing it well. In our last year's transition report, we have analyzed industrial policy from 140 countries. And the picture that emerged was not particularly pretty. First of all, industrial policy tends to have multiple objectives, right? And often these objectives may be on a collision course with each other. Think about Europe. We want to electrify transport. We want lots of electric cars on the road. At the same time, we want to protect our domestic automotive industry, right? And these two objectives are on a collision course with each other. And given that we have limited appetite for subsidies, consumer subsidies for this, in a sense, they cancel each other. Second, what we also see in the data is that in vast majority of cases, industrial policy discriminates against foreign interests because it's about protection through tariffs, it's about local content requirement, it's about preferences in procurement. And that means that this more enthusiastic use of industrial policy is going to lead to further fragmentation of the global economy. Finally, most industrial policies are enacted without having an end date. So governments are signing up to spend money on particular industry, particular region, particular firm, without saying when this preferential treatment is going to end. And once you award something, it's very hard to take it back. So where we come out in the report is, yes, industrial policy can be helpful, but you need to be smart about how you're doing
it, you need to do it well. And here you see some of the principles. First, it's very important to articulate the purpose and have a hierarchy of objectives so that we avoid a situation where various agencies, entities come up with policies that cancel each other. Second, industrial policy is as much about picking winners as it is about letting losers go. It's very important. Finally, it's incredibly important to let competitive forces to work and plan for phasing out. You know, these days where budgets in every country are stretched, where public debt is growing, it's very dangerous to sign up for spending money indefinitely. So, and that brings me to the last question. Where will the money come from, right? And, you know, in Europe, we see a big push to increase defense spending. And actually, you know, given the burden of the public debt, we are unlikely to see this kind of money being available in the near future for competitiveness. So I think the relevant question to put on the table is, can defense spending boost European competitiveness? And, you know, as you see in EBRD regions, we have seen an increase in defense spending. And on the positive side, a bigger share of that spending is now devoted to investment rather than, you know, current expenditure consumption. But I think there are three trade-offs one needs to think about in that context. First, are we spending on narrowly defined military purposes, or are we investing in broadly defined resilience? So cybersecurity, resilient infrastructure, energy diversification through renewables. Because this broadly defined investment can potentially boost competitiveness of the economy of the private sector as well. Second, there is a trade-off between obtaining what we need fast versus buying in Europe, and therefore stimulating growth in Europe. And third, there is a trade-off between having the best defense systems available today versus spending on R&D to develop the systems of tomorrow. Thank you.
Well, thank you very much to all three of you. There's so many topics there. I don't know where to start, but I mean, when we think about this sort of gap between the diagnosis and then the implementation, which of course you all live with and you've referred to, Isabel and Beata, you talked implicitly or inexplicitly about de-risking. You know, we talk about increasing the resilience of the economy and reducing the vulnerability that is created by excessive reliance on China, but you could also say there's a vulnerability that comes from just not having a diverse supply. If you don't have a very wide range of sourcing for things, then you're going to be vulnerable to these industrial policy actions. You're going to be vulnerable to a more complex global trading system. What I'm interested in, and I think even companies in this country and other parts of Europe are interested in, is politicians and policymakers talk about de-risking, but it's not clear what their lever is for achieving that. You know, are they going to be actually enabling companies or subsidizing companies to change their supply chain? Do governments even know enough about their supply chain to understand which companies need to reduce their vulnerability in certain areas? So I just wondered whether either of you had thought about what the policy lever is there in principle, regardless of like who's doing it or how they would do it.
Well, first of all, I mean, it's in the firm's own interest to de-risk. And we actually, I mean, we have analysis showing that de-risking is going on big time. I mean, of course, I mean, no company will, or not, maybe not no company, but most companies will no longer just rely on a single supplier and so on. And I mean, we see that that this is happening. And so it's not just about government policies, but it's also about
But it's often a lot more expensive. And if other people are not doing, there's a first mover disadvantage.
But that's a fact. I mean, resilience is, of course, is more expensive. I mean, there's also a role for the government to play, but it's not only for the government. The firms themselves have to play a big role in that. But when it comes to thinking about, I don't know, specific raw materials and so on, there's certainly also a role for the government to play, to make sure that there are contracts in place and so on, that they continue to have access to raw materials that, for example, are very important for the digital and green transition.
Because, I mean, we've seen that, Beata, with the rare earths, you know, as China increases the controls, we certainly, even journalistically, we realise we don't understand enough about where they fit and how much they're relied on by so many different sectors. And I don't get the impression the government really knows enough either.
Well, look, getting access to critical raw materials fast is incredibly hard. So Isabel was kind enough to show the chart from our transition report 2 years ago. We looked in that report at who owns the known reserves of rare earth. And, you know, Block West owns essentially only, I think, a fifth or a tenth. But even if you own the known reserves, developing a mine takes on average 16 years, right? So it's very hard to do it fast. So I think a better bet is to de-escalate tensions so that you don't give countries supplying critical raw materials a reason to introduce restrictions. But you know, everybody is very focused on resilience of supply chains. I think we also need to worry about resilience of market access. Right? Isabel talked about the need for companies to scale up. So it's important for Europe to continue signing free trade agreements, improving our access to markets in countries that are like-minded and are interested in doing that.
I would even go one step further, because you're absolutely right. Resilience comes in different shapes and forms. And an important one is, and we've seen it again in April, how countries reacted, it's the flexibility of the economy. So it's also about labor market reforms, right? If you have a very flexible labor market, firms are much more able to reshift, we've seen it, to countries that were able to redirect the trade. So it is about supply chains, but not only. So I really think about looking at your domestic policy and making sure that you have this ability to remain agile is very important as well, and is part of your de-risking.
And by the way, it's also about technology, because in many circumstances, it seems that you need this specific raw material, but it's often not true, because there are alternative ways of producing things. And so it's also about innovation and thinking about what alternative materials could be used.
Well, I was wondering about that, and Andrea, when you were talking about the AI, I mean, everyone has talked about diffusion in different ways, and you see that in many countries. You know, there's the long tail and it's the diffusion. It's the failure to diffuse the most efficient companies' expertise to the rest of the companies. So I just wondered how you would be thinking about that again in terms of practical policies in the labour market, at the educational level, to be increasing diffusion, because this isn't just about building lots of data processing centres.
No, I agree. And that's why I find it fascinating, because we all do a lot of work on AI, which is about the technology of it, right? And the efficiency. But a lot of it is also about how do we continue to train our workforce. And I think so the diffusion has a lot to do. And what I find interesting is the way we learn has totally changed. Before you would put people in courses, right? Send them back to university, which is a good thing. But you know, today it's not. It's learning on the job. It's mobility. Again, it comes back. It can be intra-firm, but it's the ability to learn different things, to have a wider range of skills and expertise. And I think this is going to be a big part of the diffusion factor.
And I mean, EBRD has a lot of experience of.
Yeah. So in one of our reports, we looked at IT training of workers. And when we compared workers in our countries to workers in advanced economies, they were equally likely to take free training. But in EBRD regions, people were less likely to be trained by their employers. So, one policy lever is to subsidize employer training. And to come back to the demography issue, it's particularly important to do that for older workers, because what we see is that in Eastern European EU member states, people who are 50 or older, they have much weaker IT skills than their counterparts in Western Europe.
But should we be questioning, one of the things that's always been true, we should get off training in a minute, but I do think it's important. There has always been a sort of, I think, a little bit of complacency in Europe that actually the slightly more firm-based approach, and often supported by collective bargaining and unions, approach to training and capturing it within a company, that has often been a powerful way to retrain workers where you can do it, certainly in Sweden and other countries. And we've tended to think that the very decentralized, relying on the individual having to do their own retraining, as in the US, has not been as effective in that. But do we think that is still true in this changing environment? Because it feels like the more individualized approach in the US is certainly post-COVID seemed to have quite a lot of advantages.
Well, given where demography is, and our new report is going to be on demography, it's important to keep older workers working, right? And given that in many cases they don't have the needed skills, I think there is a rationale for doing something, for governments to do something in that area.
Switching from the sexy topic of trading to the even sexier topic of capital market union, but I think there was you haven't talked about it as much explicitly in your panels, but in your presentations. But I do think sort of underpinning a lot of the conversation is to have a deeper capital market and a richer source of venture capital and investment funds in Europe through lots of different courses. And that is clearly something that has been understood for a really long time and has been talked about by policymakers with more and more urgency over the last few years. I think people just have a real question on the outside is, why has so little of that agenda come to pass when it seems everybody on paper is very committed to it? Isabel, you've at the sharp end of some of these discussions.
I give you one explanation, which is that everything that's happening in financial markets in Europe is very much driven by the banks. So the banks have such a strong power in European politics that the first project that is going to mature, the Capital Markets Union, is about securitization. And that has relatively little to do with the kind of capital market financing that we are actually talking about. So I think that is a big issue, that the banks are too powerful in these processes, and that those that we are talking about, the venture capitalists and so on, they don't have a comparable voice. So, I think that is something that the politicians need to do. They need to go to the startup companies and ask them, what is the real issue that you're facing? And what I'm hearing when I talk to those companies, it's really that they are missing this kind of ecosystem. I mean, we have fantastic startup hubs at various universities in Europe. Many great ideas. Young men like launching rockets, where you think, oh, why are they doing that? But this is also how SpaceX in the end started, right? So we do have those people, but then somehow they get stuck because they don't get the funding. I mean, one of the reasons, of course, is we don't have as much like capital-based pensions. I mean, we have mostly pay-as-you-go system. That's one of the reasons, but I cannot believe that's the main reason, because of course the money can in principle also come from anywhere, and there's of course a lot of savings around. But even though I would say the normal household savings is probably not going to go into venture capital, even though some of that could. I mean, if it's money that is in insurance companies and so on, of course part of that can go to a venture capital.
I mean, and you mentioned, one of the things obviously would be very targeted at sort of the smaller startups would be that 28th regime that you mentioned. I think everyone seems to think that's a good idea, and yet what's preventing more progress on that?
I mean, it's hugely controversial, of course, because I mean, I mentioned the areas that are effective, and I take just one of them, which is labor law. And I mean, labor law is really critical. If you have a company, a young, innovative company that wants to spread out all over Europe, it's super complicated if you have to deal with 27 different labor laws. But on the other hand, of course, if you now give the right to these innovative companies to kind of use somewhat leaner regulation, then of course there's going to be a discussion about, you know, dumping and whatever, unfair competition, lowering of social standards, and so on. So that's really hugely controversial, and it's really, so the question is how we can manage, or not we, but the governments, how they can manage politically that some idea like that can fly without giving rise to too much opposition. But I think labor law is probably the most controversial one.
Andrea, on the capital markets union, do you agree with Isabel that it's all the bank's fault that we haven't progressed?
I didn't say that.
No, I do think a key difference between the US and Europe is the structure of the financial sector, and that has really far-reaching implications. I think what is interesting, there's one microcosm that's interesting to look into that, is, for instance, and we've heard about this earlier today, is in the payment system where there's been many more fintech coming. So fintech were a good source of competition for banks. It's not been easy for them, but they've done tremendous work. So I think so she has a point by saying having this kind of competition is very important. Then you need to make sure, how do you create these areas of innovation, allow and really support it, and many institutions have supported, even central banks have often given some sandbox ideas, or have even opened sometimes part of the balance sheet to allow that. And then clearly to make sure how do you maintain the trust in the system. But I think there is something to do here. But the one thing that Europe does have is debt, is sovereign debt. Right? And sovereign debt creates a lot of liquidity. And so the question is, how can we use this liquidity to create the deep market? The reality is when you think now not about institutional investors, but you mentioned pension funds or large institutional investors, because the money is here. I mean, if you have a lot of debt, the debt needs to be held by someone. So the liability of the government is the asset of someone. Where do these assets go to? And the reality is today, if you look at the FX composition, a lot does go to the US or in different currency. Part of it is diversification. But I do think it's a chicken of the egg. There's no simple answer, but I do think there's room for maneuver.
Although going back to the Mario Draghi report, it's the joint debt that would be a good answer for that, surely.
Absolutely. I mean, I think that I think when you look at, you talked about legal, and it's absolutely true. I mean, if any of you have had to deal with it, right? Each sovereign debt is very different, has its different characteristics, is traded on a different platform. It does create a fragmentation that makes it much more difficult, despite the fact that you have a currency union, which really helps tremendously. But absolutely, there is work to do, but that's on the political side.
Mm.
I mean, I think what is important is it's not just about joint debt. That's not the full answer. The joint debt has to come along with a proper governance, because otherwise, I mean, you have joint debt and you get incentive problems, and you get a system that is inherently unstable. You need, in the end, if we want to move towards a system with like more joint debt, we also need a system that moves more towards a political union. I mean, I think there's no doubt about that. Just having joint debt cannot be the answer, in my view.
I agree.
You know, one complicating factor in this whole discussion is that the electorate is getting older. Older people vote more frequently than young people, and they have different views. We need more on the technology side. They are less likely to take risks. They are less excited about technology. If you ask them about their priorities, pension spending is their priority rather than investment in education. They are less likely to be accepting of migration. And if you do the calculation, the migration flows you need are actually very large compared to sort of historical experience. So I think big challenge is how to have an adult conversation with the voters about the challenges and possible solutions.
And just on that sort of the deepening of the capital market conversation again, I just noticed that Chancellor Merz has talked about a common European stock market, stock exchange. Do you think that would be one possibility in this area?
Well, absolutely. To have European infrastructures is already one step in the right direction. You also need a more centralized supervision, which for me seems to be an absolute no-brainer, but again,
I wasn't sure what that even meant. What does a common European stock exchange actually mean?
Well, it could mean.
I mean, it just seemed it was an interesting proposal, but I wasn't sure what it meant.
Basically means consolidation. That's the way I would see it.
And on this sort of broader question of, I mean, there's one thing that goes sort of through a lot of our conversation is fostering innovation, and Andrea talked about how we promote innovation. I mean, there's always been a difficult trade-off there with innovation and regulation, because we also think there should be effective regulation. And that seems to be a particularly acute issue when it comes to AI. Certainly the perception outside Europe is that Europe, and indeed one of the things that people in the UK identify as as an advantage, maybe say one of very few advantages of Brexit, that the UK is being sort of liberated to pursue AI in a way that, whereas so many of the big platforms have been critical and wary of the European regulation. So when you think about diffusion, when you think about what the European economy needs to get from AI, is any of that at risk potentially from the regulation that has been passed or proposed?
I wonder whether there are enough firms ready to invest in AI. So firms with funding and resources and interest in Europe. So to me, that's the first order question before we even talk about regulation.
But it is the first thing that all these companies, when they talk about investing in Europe and the future of Europe in AI, that is the first thing they talk about, is the European internet legislation and the perception that is tying their hands.
But are these companies that would want to invest in Europe, or the companies that would deploy their products in Europe? And I don't think that's the same thing, right? They may be complaining about regulations because that would limit the products they could deploy in Europe.
That's interesting.
Well, so I would say there can be no doubt that in many areas we do have a bit of over-regulation, and we have to look at that also in the area of AI. But I think what is more relevant there is that, again, this is an industry which has the winner takes most features. And that means that those who were there first have this incredible first mover advantage. And it's just very hard to catch up. And we do not just see it in AI. We also see it, I mean, one very important topic is cloud technologies, right? And we see it. We have kind of the hyperscalers who offer so many features, analytics and whatever. And of course, there are providers in Europe. They're still relatively small. They're not as advanced, but they would need, the push in order to get to that level. And I think from a sovereignty point of view, I mean, one has to make sure that also in Europe these firms can thrive. One has to look at regulation, whether this poses any obstacles. But I mean, we know it's very risky to just rely on foreign firms for these essential services.
I want to pick up on that point, Isabel, because it's absolutely true, right? There's a little bit of a timing issue. So Europe comes in, a lot of in AI, a lot of the models, but also the producer of your microchips. But just think about the models, right? They all come from the cloud, all comes from the US. The models all come from the US. They're trained on US data. So I think it's going to take a little bit of time to get the confidence that these are the right things. And I think technology innovation helps. For instance, until now you have what, 4 or 5 large LLM models, these foundational models. Well, you can't really it's very hard to test them. You don't have access to the protocols. You can't, so from a sovereignty perspective, let alone that it's used on a different data. But now you have small language models that are coming, that you get a greater control over them. You can run them differently. So I think it also takes a little bit of time to get confidence, because I mean, it's pretty dangerous, right? If you don't realize that you're creating hallucinations. And the thing is, these issues with AI that we have, they're not bugs that will go away. They require really a different thinking. And I think that's why, so regulation might be one, but I also think when there are these sovereignty issues where the risks are pretty large and you have to be careful before engaging.
Sorry, do you want to say? And there is, of course, the question of energy costs that was already mentioned.
Yeah, that's a big one.
And I mean, and that is one area where, and obviously Mario Draghi also highlighted this importance of reducing the internal barriers within the European Union, and one of the big one of the big effects of that is to improve investment and lower the cost of energy. I mean, all of these recommendations, almost all of them, have been endorsed by leaders, by Ursula von der Leyen. Is there a way to cut through some of that apathy, or the slow pace of change? I mean, if you think about how much has changed in the year since Mario Draghi delivered his report, the world has moved on very fast. Supply chains have become very complicated. The cost of energy, or the needs of energy, have become even greater as we look at the demands of AI and other things. And yet so little movement on that report. I mean, is there, just as a question of advising the member states that really do want to make progress on this, what are the best things for them to be pressing on to do better?
See, I wonder whether this is an issue of bandwidth of policymakers, right? A year ago, we talked about Draghi's report. It has shaken up Europe, and there was interest and willingness to do something. And then other shocks have taken place, and suddenly more urgent things have become priorities, and competitiveness has fallen down the priority list because there are other things that one needs to take.
But a lot of the things that have happened have made those challenges more urgent. I mean, if you have diversion of Chinese imports that were going to the US and now coming to Europe, so that's increasing the competition for European companies. You've written about it as a demand shock for European companies. I mean, I would have almost thought the opposite. I would have thought it would have increased the level of feeling of urgency.
It has, but defense is the top priority. Then there was the issue of trade relationship with the US. That was very urgent. So, I think that could be one explanation.
What should they do?
So, first of all, I think this kind of counting in terms of percent of Draghi recommendations, I don't think that's a very good way to proceed. I mean, it's good to show that too little has happened.
Would you say that the important stuff in the report has been implemented?
But that is the main thing. Yeah. I mean, you said there is a large number of recommendations in the Draghi report. And maybe that number is still much too large. So the first step would be to identify, which are the true game changers? Which are the things that really matter, and to focus on those, and not do everything at the same time, which then takes forever, but to identify like the 5 key projects that really have to happen. For me, the 28th Dream would be one of them, but there are of course others. And to focus on those and to not focus on 363 projects. And if you can deliver on the 5 key projects, that would be enormous. I mean, and apart from that, I do think a lot of things are happening. I was personally very surprised that the Draghi and the Letta report were perceived in that way by the political system. I found that very surprising, that they really took that on and said, okay, this is our agenda. I mean, that we have to pursue it. That's quite impressive, and at least things are, I think, going in the right direction, too slowly, of course. But I think it also has to be seen that this is quite something, that these reports had such a big impact.
Do you think, we're going to go to questions in 1 minute, the only other, to sort of inject a little bit more optimism into the conversation, I mean, there is one thing that has really changed. I mean, we spend a lot of time worrying about the structural issues and particularly, the instability in France, the core economies of the Eurozone, seemingly finding it very difficult to move forward in key priorities, very obviously in the case of France, but it's also, one has that feeling around Germany. The flip side of that is some of the countries that we've always thought would find it harder to achieve structural reform and sustainable growth, manage their fiscal policies, are actually doing extremely well in the south, or at least relatively speaking. You know, the higher performers are now Greece, Spain, Italy, Portugal. So I just wondered, are there opportunities there? Is there scope for those countries to be sort of pulling the European economy forward in a way that has maybe not been the case in the past?
Well, let me add that Poland is doing very well, right?
Yeah.
Among fastest growing in its region. And, you know, what is helping there is, you know, it's a larger economy, so it's more diversified, so it's less influenced by external shocks, external demand, particularly sort of weaker performance of Germany. And also, you know, public investment is helping out. So, you know, again, coming back to the need not only to invest money, but also by governments, but to invest it wisely.
So I'm going to make a very basic point here. A lot of it is about investment, right? And you're asking us, you're asking Isabel, you're asking me, with the Bank of Central Bank, you know, what's happening on the political level. Well, I'm going to say, in order to invest, fine, you need money, but you need trust in money. And I think this is what central banks do, and you need trust in money that's in the value of your money, that's your monetary policy, that's financial stability, because you need to invest, because in order to invest, you need to have predictability in the future, and you have to have confidence in the future, and you need to be able to calculate your return on investment. And also, and this is where innovation has also played a very big role, you need to be able to pay to transact internationally. Domestically, of course, but that works well, but also internationally. And I think that it's more of a rail system here. It's like, how do you transact? How do you invest? How do you pay? How do you make all of this with trust? And I think this is an area where innovation is really at full bloom. We also have the whole tokenization, the whole blockchain. And I think this is a very important area, and that opens up a lot of opportunities also to get it right. And I think this is an area where central banks are more comfortable, because that's within the mandates to move forward and make sure that you also create conditions that allow for investment to bloom.
Mm-hmm. Okay,
yeah.
I'm sure there's good. Oh, sorry, yeah.
Very briefly. So, I mean, one of the things, of course, that is has been holding Europe back is that we're always trying to form a consensus on everything, and in certain areas we also need unanimity and so on, and that has been holding Europe back. And so I think we need to move more in the direction of allowing for coalitions of the willing, because you said in some countries it may be easier than in others, and actually if some move ahead, others may then find it easier to follow.
We will see. Okay, so there's a question in the front row. We might take two here, and then we'll...
Thank you very much for the fascinating discussion. My name's Yuan, I'm from University of Chicago. Thanks to European talents, especially past PhD alums of University of Bonn, some of you you may have taught Isabel, we've collected hundreds and thousands of years of data to show that the rise of scale and large-scale firms is a historic inevitability and extremely important for innovation, but with two caveats. One is, in the data we see that these large firms predominantly get larger with capital, not employment. And two is, of course, there's always sour popular sentiment against large firms, against scale. And interestingly, in the US these days, probably many of these panels will be talking about inequality, about market power, political influence, and social concerns about scale. So how do you think one can strike a balance to take advantage of the technological necessity of scale, but then also avoid polarization and imbalances?
Okay, and I'll take the question here as well.
Irina Steven from the University of Hamburg. I have one question to Isabel and one comment to Beate. Isabel, given that we know that firms rely in Europe so much on banks, and we've been talking about banking integration. We know that the cross-border bank to non-bank flows are so low across European countries. Why do we not still have something like Euro-wide credit register? And for Beate, you talked about investment in defense and innovation in defense. And I think that one of the positive sides of this terrible war in Ukraine could be the possibility of the defense firms to have this testing ground for all the innovations. And this is what we see that in the last couple of months is German firms have started to do. But this is where we could push much more and also use this as an innovation in defense. Thank you.
Okay, we have a pretty broad question and then two quite specific questions. I don't know, do you want to take on the specific questions first? Yeah,
I'm happy to take. So on the, so who innovates, right? If you look at who patents, it's large firms, multinationals, and then, startups. And yet, any multilateral development bank, government agency spends a lot of money supporting SMEs, right? We should be supporting young firms, not small firms. It's a point that's very obvious in this room. We should be supporting R&D through maybe tax credits that would go to large firms. This is politically very unpopular because politically there is this perception that we should be helping weaker firms, right? And somehow we need to change the discourse and educate the public about it, but it's incredibly hard. On R&D investment, I think this large funding that is available for defense, big chunk of it must be used for R&D. Otherwise, we have no hope of catching up with the US.
Mm. Can I ask, because it's a broad question, it's a very good question. In my view, it has two words as an answer: fiscal policy or regulation, right? But I mean, that's a political decision. So it's a simple distribution of wealth, right, across the economy. And I think that's where ultimately it's a political question and it should be addressed to fiscal policy.
Though it hasn't traditionally been a simple distribution of wealth, but yes. I mean, it's not a simple question to solve. It's just a political question.
No, I didn't say the implementation is easy, but conceptually, this is the best tool because you don't want to squash the innovation, right? You want that, but then the other objective that as a country you may want to achieve, and then this is where you get public policies. And from the range, so this is not necessarily a structural policy, it would be more a fiscal. Of course, you mentioned tax credit for other things, so then it comes into that. But that's the way I think about it, because you want to really encourage innovation. And innovation is going to have those effects. But you want that. But then there's a way to deal with it in order to fulfill other objectives.
So a very, very interesting question on firm size. So a couple of weeks ago, I was in Italy, in Milan, and I was walking along like the city center. It's really nice because you have all these wonderful, nice little stores that have basically disappeared in Germany. So of course, probably many of these stores are not terribly productive, but we still like them. And so so there is something also to having smaller firms. I mean, the thing is, we have to, if you look at my chart, you probably couldn't see it because it was too small. But according to that data, 30% of euro area firms have less than 10 employees, and 50% of euro area firms have less than 50 employees. So we are really talking about very, very small firms. We are not talking about do we want to have firms that are large or super large, but we're really talking about do we want to have tiny firms or like a bit larger firms where maybe the downsides that you mentioned do not yet fully come up. But it's absolutely clear that firms can also be too large.
So Irina, on your question, I mean, we do have a credit registry for corporate loans, right, the ANA credit. We hopefully will also have that for household loans not too far in the future, but in principle, we are moving in precisely that direction.
Just one thing on the small firms, it's just something I noticed in the UK. I mean, there's everywhere actually. I mean, politicians tend to really like doing things for small companies because it's associated with dynamism, as it goes to your point. And actually, you should far more often be focusing on the fast-growing firms, and it's not about. But they use size as a sort of a proxy for dynamism, and it's just. I mean, to your point, it's just not the case. But anyway.
But actually, I mean, those who have the closest connections to the government are typically the large incumbents, many of who are not very...
but all the special sort of tax credits and the exciting things to do with R&D tend to often be for the small companies, and they could have been 5 people for 10 years. You know. Anyway, it's my little bugbear. I think we've probably not got time for any more questions unless there was a really pressing one question, a really good question. No? No one wants that?
Okay. May I say one more point, because I always think it's underemphasized with regard to capital markets union. Nobody talks about it, but I learned that many things are about taxes. When you have a problem, many of the things are about taxes. And there's one really big tax distortion that we have, which is the tax bias which benefits debt and disadvantages equity. I think that is actually, it's also one of these really big issues that could be solved, and that would make a huge difference.
Except you've already identified why one of the reasons it doesn't happen is it's not good for banks.
You're right.
So, you know, we know why that's not happening. With apology, well, I wanted to ask one more question, but just as more of a sort of how should we think about this problem, because I think it comes up with the IT, and I just want to take advantage of having such a great panel. We hosted a conference for professional economists last week at Bloomberg, which I'm afraid was not only women, although there were plenty of women. And one of the speakers, an eminent academic, said in describing Europe's position and looking at the share of the economy and demographics over time, looking at the future, he said, you know, in the future, Europe is going to be like Switzerland to the rest of the world. You know, still fairly affluent, but just not important for anything. Now, again, with apologies to the Swiss. I know, I did apologise to the Swiss, and of course there are some Swiss people that are very important, but as a global concept, I just wondered whether that was optimistic. I mean, are there risks in this environment to our basic ability to maintain that level of standard of living if there could be sort of really quite dramatic technological change that so far Europe is not grasping? With one sentence, do you think that is an optimistic or a pessimistic view of Europe in the future, Europe's global chances?
I think we need to start addressing demographic trends today while it's still politically feasible, because tomorrow it's going to be too late. Right? And depending on whether we do it, we are going to find ourselves in a better place or worse place. We may not be Switzerland because the standard of...
we're not accepting the Swiss parallel. I'm just waiting but just
I'm not going to comment on that one. I'm not going to comment on that one. Look, I'm wondering whether we are not coming out of a long history, and I saw some beautiful panels that, you know, of concentration, globalization clearly, and whether there is something about diversity. In the true sense of the word, why do we all regions need to look the same, to have a similar financial system? Why is one necessarily better? Because I think resilience is exactly to have different things. If you look at Asia, they're organized very differently in many different ways. And maybe that is what is going to give us resilience going forward, is not all to want to go to one standard. And I think, because in some areas, I think Europe is standing up relative to what is happening in other parts of the world. So I think it depends, first of all, what the objective is. But I also think let's embrace diversity in its true term. I'll stop there.
Including on the shopping streets. Yeah.
Including on the shopping streets.
So one sentence. I think if we don't maintain our influence, we will not maintain our affluence.
Oh, that's
great
a nice
line.
One.
Wow, right, we can all steal that. Thank you very much.
Very nice.
I think that is it for today. But as you know, there's another full day of exciting discussions tomorrow. Thank you very much.
All right.
Very nice closing. Wow.